Good morning, everyone. This is Rose. Today is August 23rd and Friday. It's 9 a.m. Eastern Time. I am losing connection constantly. Are you guys experiencing the same thing? If you're using NinjaTrader. Good morning. No, it's the connection that is constantly kicking me out. So I'm not sure I'm going to be able to place a trade safely here. But anyway, that shouldn't stop us from finding trades though. All right. Where are we? 56.29. Yeah, so market is making its way up to the ledge as just to pick up where we left off yesterday. Late afternoon is with the market close. I said the market ledge area, which is 33.50. Market is trying to get there. And at the open, we are going to test most likely that price point and get above it. Okay, so we are extremely close. So 28.50, we tested 29.25. Yeah, I mean it's not so far away. All right, so pre-market after hours actually I said that the market is probably gonna go up because we do have a wedge bottom, and this area I said it's probably support, so we tested it, and then at the close I had some bear targets. We met a few, and then maybe we only met one, but we met that, and then we just reversed back up. So it's been trying to recover. The strong sell-off is right here, so they're trying to close the gap and get there. That means they're gonna strike these levels that I marked on the chart, and we might even go further up, but first here we should come down, found supports, and then go, because we have separated from this moving average. Problem here is that the separation is not all that great, but it's getting stronger. Here there will be some profit taken at the open, and then we're probably going to pull back. I'm going to look to see if I can re-enter once again. I need to keep moving this because the Globex range is extending. Globex range is right now 32 points, so it's trying to reach the 40-point level. Yeah, so it should reach there, but we'll see. Yesterday was an outside down there, so we're gonna open up, and I said most likely today could be an inside day, but if the inside day closes on its side, then that's IOI breakout mode. Market could try to make a new high. If it's not today, definitely is Monday or Tuesday. But we'll see. It could be just going up. I'm looking for a sell zone, which is right up here, and then come back down from there. So that means today can also close on its low, but it's going to open up as an inside day. And then let's measure yesterday's range. I also need to find the midweek. So higher week and midweek and lower week, because today's Friday, so you kind of have to pay attention to those. Okay, so this is from yesterday's. So this right here is 66%. So we're going to this, not only the ledge, but the 66% area. So from the close, that's close of prior day, but I'm going to mark ledge and this area. So this area is important. This is where market is trying to reach. Actually, that should be green, but only for profit-taking purposes. Okay, so that's what we're trying to reach at the open. we could go higher than that and reach this area right here, 56.48 which is slightly above my level. So you can see how these levels are right now attracting the price. One thing that we failed to do yesterday, we did not test the 50 EMA on the hourly. However, when we open, that could change and close that little gap because it's dynamic and it's calculating with the bar open and close. So by the time that price opens up here, suddenly that could look like we're already testing. But it could be also go up and test, up here and then come back down to it again. But we're gonna, since open up way too high, I'm still gonna look for sellers up here. We're gonna be in some kind of a trading range. So that puts us in a trading range, and because hourly on daily chart, we're gonna open up in inside day. All right, so let me find the weekly high low. So the 19th to 23rd. Here is the week low. That's higher week. Monday, Tuesday, Wednesday, Thursday, Friday. All right, so Jackson Hole Economic Symposium has been started today. So we have new home sales 10, and Jerome Powell will speak. I think he's there, so he's going to have a speech there. It's kind of an important event, so we need to pay attention to that. 10 o'clock, it's going to be very hectic. I'm sure we're going to be hearing from other Fed members as well, but the most important is Jerome Powell at 10 a.m. I would not recommend anybody trading that hour. Good morning, everyone. So I would be careful. But other than that, nothing in the afternoon. It's just an all-day event. I think it was an all-week event, but I'm not sure. I don't follow those events. All right, I'm going to wait for market to open. What I'm going to do is going forward, well, I'm probably going to forget doing it, but I'm going to try to do this consistently. I'm going to mark some of the good bars that we should buy and sell. I'm getting a lot of questions, but I gather that people are not really taking the course or not going back to the course videos. Like when you look at this chart, you should be able to tell which bar is a good bar to sell or buy and how much continuation you should be expecting. Like you shouldn't be even hesitating, right? Is thinking that this price bar should be getting leg or two down. This is the same. In fact, you have two. Even though you're in a trading range, you should still be expecting these lows to be taken out and the market to sell with another leg down at least. You got two, leg one, leg two, or a leg one, and this is the leg two. So market is in a downfall, right? So you have lots of gaps open. I mean, you can even determine the market is going to make its way down by just looking at the line chart, and you can see that these gaps are maintained. There's a gap here maintained. There's a gap here maintained, right? There's a gap here. There's even gap here, right? So ton of gaps, but now we're going sideways because you do have is leg one, maybe pull back, leg two, pull back, leg three right here. So what about, this is the leg one, this is the leg two, and we go all the way up here. and we do not touch here, and it comes down and makes a leg 3, but ends up becoming a higher low, and we reverse back up. Yes, it's possible. We could do that. You know, last leg, I like to see it taken out, the lows, but I'm going to count this as leg 1, pull back, leg 2, right, pull back, leg 3, sideways. Now we're opening up here, but if we start to come down very strong, okay, and close this gap right here, market in fact, actually, without touching here, could come down. Then you have a leg 1, pull back, leg 2, pull back, leg 3. There will be buyers waiting here. However, is if we bounce and the bounce is very weak, then we can come down and test these lows, right? So then it would be some kind of a expanding triangle. But if we go and test here, is we could also come down from there. I'd be looking for a double top opportunity right there. Okay, come down, make a lower high, right? So, and then come back down and this way. And there could be, again, right around here, I'm going to look for 2 touches and bounce. It's going to act as support. What about we break here and we continue to go up, is I will be targeting this gap area. Now we could even also go up there and make a double top and then swing back down. But yesterday is pretty strong bear day, and you should have expected to sell at an above moving average. You should be looking for double tops, and you can see the double top right there. Even triple top 1, 2, 3, and then came down. You have 1, 2, and 3 wedge bottom, but within a range. So you should have favored short trades yesterday more than the long trades. Now, this was a deep pullback because you got a channel here, right? It has to trap the traders. It trapped the traders here. Now it's trapping them and then coming back down. It's going to take out that low. And then, I mean, I'm not doing all that great, but if you put extensions here, it's going to test that extension before reversing back up. Magnets down below. We failed to go below the open of the week. That's something. And that means, I think, when something like this happens, bulls are trying to keep some amount bullishness, in the market. So they're trying to prevent that bear close, which market can become a lot more bearish. So they're preventing that, which is a good thing. So then I'm going to say, okay, if they were able to do that yesterday, what are the chances of breaking this and then actually making a new high today? Well, even if we cannot make a new high, we could make a double top, or we go and trap and then come back down to the 50% again. It is possible. This, to me, is a hint, and take a look at here. This is actually a classic reversal pattern, other than being wedge bottom. But really, what you're seeing here is, you may not see it, but down, trap. You see this? 2 bull bars like that, target here. But what you're going to buy is a small size, not a big size. Then you're going to see if the bears are not selling, then you buy again. You're now targeting these highs. So market is trying to reach there, maybe even higher. But there's a breakout test area and strong sell-off right there. So this area is an important area that the bears are waiting. I'm going to mark that with block of yeah, so we should get there. This whole area is resistance. Okay. Well, I already talked about the hourly chart. Same thing, we didn't really touch is 50 EMA, and it continues to go up. We're going to open up here. I'm looking for a double top. channel is right. So bulls trying to break this area and go higher, but the problem here is that you now have testing. There's a channel here. The testing that, again, if we cannot take out those highs, that's going to be a failure. We could come back down. So that means we could come all the way down to these levels. There's a gap here. The bears want to try to close that gap. But we'll see how bearish it gets. So right now we're back to being above last week's high. But we're within the range of a strong bear day. It's kind of difficult to undo this. My desktop application for Discord is no longer working. Is any of you having that issue? I couldn't launch it again this morning. So I'm limited to, I'm looking at a tiny little screen. I'm looking at a tiny little screen. I don't know if it's an isolated issue or site-wide issue. I don't know. I did try closing it from this task manager. It opens up the application, but it's just black. So it's that background. They have that gray background for and nothing loads. I did all of that yesterday and today. It seems to be not responding. All right. Maybe something to do with my graphic card, because yesterday or 2 days ago it said that it needs an update suddenly, which I updated the drivers last weekend, but maybe something to do with the graphic card. Windows is up to date. I do that every night. But, oh, you have the same issue. Okay, so it's not isolated. All right, I feel sorry for us. But I can't see the comments. It's just another computer and it's hard to type. Oh, thank you. When? Take a look at that. How to fix Discord not opening on PC is okay. I'll take a look at this. Thank you so much. Yeah, I don't use Wi-Fi either, especially on my. I use the Wi-Fi for, leisurely things, but not for trading. I'm hardwired. But that still doesn't stop the lagging. Ninja still lags. It's like a couple of seconds, not couple of seconds, but milliseconds behind. More than a couple of milliseconds behind. Like I look at the data provider's window, I get filled faster there, but not on the Ninja chart, even though it's hardwired. So it's frustrating. People trade with so many accounts at the same time, and then they complain for, oh, copier just dropped me. No, it's not the copier. It's that your Ninja is behind. And you could be also getting filled late on the SME because you are CME. I mean, you are looking for priority. Since being a retail trader, you're still looking for priority and want a perfect fill. You have so many accounts, but futures is a first come, first serve. Priority is to those hedge funds, and not just the priority. It's because they have so many more orders than you do. So if there is a think of this, 10-mile long line Q, and you are on the 8-mile marker. That's because the first 8 mile is filled with all of those account managers or traders, institutional traders, account managers, brokers ahead of you. So they get filled before you do, okay? That's why we say front run, take profits. That's why I say I'm taking profit 1 or 2 tick below my targets. So and then people complain, oh, I didn't get filled, it dropped me. Nothing drops you. That is what you ask is executed by a piece of program. You told the program to put your limit order somewhere, and it did. But how you get filled, it's not up to it, it's up to the CME and to you. So if you really want to get filled, use MIT orders, market if touch. Market if touch is basically going to put you in front of the line, but it's not going to give you the best fill. It could be 1 or 2 tick is slippage. Generally, it's just a 1 tick slippage, but you could get that get filled before anybody else. So that is the only way you should be getting around it. If you're trading with too many contracts, too many accounts all at the same time. So let's be logical. All right, market is up and about. All right, we opened above the midweek, but there is bulls actually did close this gap, but there's a gap right here. So we were right at the resistance here, but we could find support here. It's also support right there. I did say we're going to open somewhere in the middle last night for today, and we just did that. So let's see how this pans out. There's a trading range. We're kind of at the upper third of that trading range, but really there is we're at the 50%. Oh, something's wrong with this one. So we're right at the 50% right there. This bar closes bullish, we're going to continue to go up as long as we stay above the midweek. But if it closes bearish and we get another bear bar, we can come down. So I don't know. I need more information. Just mark that. ATR is not so bad. Oh no, it is bad. That's 12 points. Yikes. All right. Things are going to move fast today. Bears looking to test 56, 16, 1650. I don't know if they can break 1850 or 1650. They can drop all the way down to 5613 area. So just watch out there. We could test 1650. And bounce, or we break 1650, we could drop into 13 or 1275. 13 or 1275. Midweek is still holding. There's resistance here on the hourly. I mean, the bar one closed on its mid, maybe slightly lower, but it's just a midpoint. Is nothing exciting about it, but there could be still sellers. But if we get above it, then we're going to trap those sellers who already sold. Try and get to the ledge. But bulls need to close a bull bar. we are too far up in this trading range, and also 20 bar is average, right? So 20 bar average, this is the average price. If we cannot find the bulls, if we cannot make a new high, then we could start coming down. But we start making new highs, this is going to be obsolete. But we start to get bear bars, we could pull right down here. So it's the bar 67 high. But we could go make a wedge top 1, 2, 3, and then sell. I'm not trading this, I'm not touching this for now. It's not a good place. I want price to either get here or pull back. It's 2 bars overlapping, so small trading range within the top of the trading range, or in the middle of this move down. So it's not clear, and 20 bar, I'm counting 19 now, 18 bar from here, and 2 bar here, 2 bar here. Still, the high of 67 is average price. If bulls don't want to buy here, we might need to come down. If they agree that, okay, this is a good price, let's start marking up, then yes, we'll go higher, but I'm not touching this. That decision hasn't been made. So just put a line above bar 1 and high, and put a line below at the low of bar 1, and see where we're going to get the breakout from, at least. And then the pullback, you need the pullback too before entering. This just, I'm a retail trader, I have to watch at the open what I'm doing. I can turn the entire Friday into a fix the bad trades and catch up day, which is no fun, right? It's too tiring. You lost a lot and you're trying to catch up, make it all back, or break even day. Nobody wants that. Bears want to sell and test the bar 1 low. They want to test 56.18, maybe 56.16. But maybe a better place to sell here, so I don't know which way it's going to go. Bulls trying to close above open of the day, therefore bar 1 high, bar 1 open, so that they can turn the day bullish right here. They didn't get a chance to get, nope, that's all right, now they got above bar 1, but they need a bull close. Only with a wick, so I'm not touching this. This is overlapping bar. So already market is betting against bears, and it could bet against bulls also here. But this is good for bulls due to this magnet here. So they're showing me signs that they want to go up, but I still am not clear. I think I'm just not going to take the trade. Because of this gap. So they're trying to overlap with bar 39 from yesterday, but failure to close this gap is we could suddenly come down. So I'm not very excited about this for bulls. Gap up within a trading range is very few. It's a massive gap up. So I don't trust this. We're in the sell zone. We start to close bull bars, and that's great. We're definitely going to go up here. But I just want to see it. Now you have an outside bar 1, and inside bar 2. Bears want to take out the inside bars low. If the bulls already bought above that bar, so they already put a stop there probably. So if suddenly bulls start to take out the inside bars low, it could come down and test the bar 1 low. And this is what I was worried about. We're going to test probably 1975 to 1750 if we can take out the inside bars low. But 3-bar overlapping, so you can see that this ended up opening as a limit order market. Is for now, machines are betting against strong closes. So bulls betting against strong bear close, bears betting against strong bull close with bar 2, but this bar has to also close below its midpoint. It tested the open of bar 2, but didn't test one tick below. So technically there is no breakout to the downside. Stops for the bulls are still intact, but I'm sure they are shivering with fear right now. So hopefully I kept you guys out of buying above bar 2 for now. Okay. If bulls close this bar bullish, they're going to try to go 7 points up. If suddenly we get a bear close, we're going to come down. So this bar closes like this. They're going to try to scalp about 7.5 to the upside, but only if it closes bullish. If it fails and closes bearish, then bears are going to start scalping half the ATR and 1 time the ATR to the downside. So it's still not clear. It's still bet against and scalp half the ATR. So you can see, look, if a bear sold above or the close of bar 2, that's 26.50. Half the ATR is like 3.5 or so. So right, 23.50 or 23 minimum scalp, and bar 3 gave that to them. But so they're scalping, right? It's a scalping machines environment here. But now bulls are trying to close a bull bar so they can get half the ATR scalp, and 1 time the ATR, since it's pretty healthy, swing up. But where's that bull bar? So we need the bull bar. We don't get it, then bears can bring it down. So it's still not clear, but slightly becoming more bullish. Bulls try to close above open of the day. They did that with bar 2, but no consecutive bull bars. They're trying to close for the 2nd time with bar 4. If the 2nd time fails, then bears will take over. Bulls trying to get a small triangle here and a 2nd entry long, but we need a bull bar. If we get a bull bar, then bulls can run this up to minimal 29, 25, maybe 31.75, and then the ledge 33.50. So they just need to close the bull bar. We still don't have a bull close above the inside bar 2, so still not clear for bulls. If the bar 4 were to close bullish above the high of 2, then we would have gone to the 29.25. So now we come back and test the midpoint of this, whatever this is. Could be a bull flag, maybe spike, channel up, and then see if we can close a bull bar with this. If we close a bull bar with this, market will go up to the 29.25, and then further up to 31.75. But if the bears take out 24.75 or so, we could come down. That's why it's just so difficult. It's a scalping environment. Well, it's better to wait. Sometimes you have to wait about 6 bars, 12 bars, but you'll get a good setup eventually. See what happened there? Another failure. But we could still find some buyers here unless we, okay, so it's a done deal. So now we need a bear bar closing below the bar 2. The first target for bears will be 1975 and then further down it could come down to 56.17. But again, they need to take out the bar 2 low with a bear body. Actually, I'm sorry, I'm wrong. The target would be for bears, 1975. I was right. But again, they need to close a bear bar. Without closing, bulls can now take over. No matter how many times I say it, it's just stay out of this. It's limit order, 5-bar trading range. It's limit order, 5-bar trading range. Okay, now bulls are getting their second entry long, but still we don't have a bull close is above the bar 2 with a body. Well, maybe one tick though. Actually we do. It's a one tick, so bulls are trying to get to 29.50 and then further up to possibly 81.75. But it's a doji, so that doesn't make it any easy for any bull wanting to go long. But technically, it's they want to go up to 29.25. Dojis are difficult to buy above, and we had a good example yesterday's price action. And that's right there. Another one right here. But it's slightly hinting that it might. But now if we get a bear bar, then it's a mess. Let's just sell above, is buy below, sell above, or sell above, scalp in the middle. Kind of open. Okay, we're testing the midpoint once again. If you measure this entire, either the inside bar or the outside bar, bar 1 or 2, we're kind of in the middle. So market still can go up to 29.25, possibly even we have about a minute left for the news. I think market is waiting for that. If the bears close a bear bar somewhere down here, we'll sell. But they're trying to get up to the ledge, the magnet above. The area above is get a breakout, maybe, I don't know, from the Globex high. Since we're so close to the Globex high, we might get that breakout. There you go. Okay. Wow. Okay. Okay. I did buy, and I scalped here, and I just ran quickly to my target and took profit there as well. This area is a sell zone resistance. The only time the news bars will reverse is quickly or respect. That's support and resistance, okay, or supply and demand zones. So that is resistance, and we marked it together pre-market. So I've taken profit, and I don't care what it does anymore from now on. Okay, so I did say is right here that it was slightly getting more bullish, but just slightly. And as I bought it quickly with the bar close, and now it's going up. Where can it go? It could go up here as well. It's breaking the resistance. I'm gonna get rid of that for now. But it's trying to maybe get up to the prior high. I did say if we break this area, okay, it is possible that we could get there and make a new high. The problem here is that we go up and then we could come back down again. So this is news, and you just need to, there's a gap here, be careful, there could be sellers here. Bulls are trying to close the gap. And anybody bought this bar yesterday is above bar 5, trying to get back to it. We might try to close this gap, but if this gap fails to close, we could come down. It's a big bar, so a bar like this is probably going to get followed through. We're in the gap. You needed to take profit in case it fails. But I think if they close a bull bar on its side, we could get followed through. Some profit taking happen because we just hit a bunch of sell orders. If the bulls can weaken this, we could go higher. The high of week is magnet. Since it's Friday. Very big bar. It's difficult to trade this bar. If you buy this bar, your stop is down here. Now, we can go higher and then go sideways and reverse back down. It is possible that could happen today. But a bar like this should get somewhat follow through. Possible that could happen today. But a bar like this should get somewhat follow through. So if the bulls, since this is the news bar, if the bulls actually close above this, we're going to get higher prices. We could reach around 56.60, 56.65 coming down, before coming down. But we need to close above it. So what happens if the bulls bears start to take out the bar 7 close? Well, they're stuck up here. So they're going to utilize the 50% to 66% pullback and try to buy again. This area now, resistance now, its support is, if there are any buyers, they're here and a little lower. But this right here is a problem. So you see why I took profit and I'm done. I'm not trading this. I am not in this because this is any gap, a bear body gap is natural resistance. So is knowing that, it's a news bar. I want confirmation that the bulls want to go higher. So that means they have to take out this bar's high first. If that doesn't happen, I'm not interested in buying. But stock bulls bought the 50% pullback as suspected. So now they're trying to get to an average price or take out the open of close of bar 7 and see if they can continue to go higher. ATR is 11 3/4, so the bar is going to plunge. It could plunge 11 point down and then go up. So it's very risky to trade these news bars. Not many can trade it with ease or, steal nerves. I know I can't, so I exit it. All right, so they brought the price back to where they are roughly stuck. So if they don't allow this bar close on its low, it can go higher and take out the bar 7 high. But suddenly this bar closes somewhere down here, midpoint of bar 7, many will exit out. But it looks like it wants to go higher. So trade small at least. Market wants to test around 59 to 60 area, above 56, 59 to 60. But we need more bull bars. Big bull bar is trying to get another probably leg up. All right, so if we do take out the high, then that's good news is for the bulls. Now you have a bigger outside bar followed by an inside bar, 7 and 8. My stop was underneath 5, higher low. It's a flag, double bottom. So I entered, put my stop there, and then I immediately moved the stop. I got in with 2 contracts, scalp 1, left 1, and moved the stop. So even if it came down and took me out, it would have been a win for that contract. I'm looking for bulls to push this up a little bit more, and then if we start to get sideways bars, bunch of inside bars, bears will try to sell. So they are right now closing the gap. They just need to close it higher. We could get to the high of yesterday. I'm more interested in the 60, 59, 60 area and see if there are any sellers there. Could go up to 62 since ATR is large. It could definitely test 62, 61 and 62. Could go even 10 points, 5 to 10 points above 62. So that's 67, 69 area. So it could get above high of yesterday. Remember I said we get above this inside bar and this bar, we get another bull close. I didn't like bar 5, but that was a second entry long. You know, you go for what was the ATR there. So sorry guys, I'm actually trading right now, so I'm gonna get back to that. Just need to keep my eye on my trade. I keep forgetting that I do that and I immerse myself into explanation. And I forget that I'm trading, not a good thing. So let's go bulls. All right, so to explain, I just moved the stop so I don't need to worry about it. A board again, right there above that inside bar is strong. It probably wants to go higher. Scalp, move the stop so I don't need to worry about any of it, even if it comes down. So here we have breakout, right? If you buy the close of this bar right here, at that time, the ATR was close. We were right around here, around like 7, 7.5, right? So, you know, you don't know how much it's going to go. Yes, it's news, but pretend it's not a news. Okay. So you're looking for from the close of that bar is about 750, right? And 750 is right there, right? It's one time the ATR, and then ATR increased. Look at that. It went up to like 1250. So increase it. Take a scalp there. Bar is going. So that's 1250 right there. It's still going. So this time, if it's 1250, now double it. That's 24. So your runner should be going to 24. And then you should be taking profit there because ATR came down. So you should be taking profit. So you took profit before everybody else got trapped with that upper wick. If you want to use the ATR. If you don't want to use the ATR and you enter, just simply move the stop. Or wait for bulls to show you that they want to get above the news bar and then you look to buy. But according to BTC, you know, a bar like this should get follow through. or another leg up. So you do have a spike pullback channel. Eventually, market will try to come back down to here, okay? So somewhere here, if we cannot get above high of yesterday, market will go sideways. We're going to come down. We're going to try to go back up, and that could sell. And we could even come down and take out the bar 7 low. If that happens, we're going to get even lower prices today. So right now, it's bullish. It's trying to get to the high of yesterday. I said on Fridays, the weekly high, weekly low, weekly mid levels are, even the monthly is, since we're getting closer to the end of month, but we're not necessarily there, you can also mark those. But I look at the weekly highs and weekly lows and weekly midpoints. Okay, I just got hit. My stop is hit. I'm out. I can't take big risks with this because it's just like 20 points, 30 points. I can't do that. So I just moved the stop. So we're coming down to the midpoint of the outside bar 7, okay? If the bears close below the midpoint, which is, I think, 40.50, we are going to come down even more. Then we're going to probably test the 35 area. My Ninja is really unresponsive today. It's just everything's lagging. I can't even select the order. I hate when that happens. Let's just wait. So we just tested the midpoint of bar 7, and there were buy orders there. So that's why we're bouncing. But if we close a bear bar body, we're going to come down to the 56.35, slightly under possibly. So we could end up testing 35 and 34 area lower. Only if this bar closes below 40.75. This bar closes below 40.75. It's right around here, so they are closing. So we might end up coming down and testing 35 to 32, 33 area. So probably we might overshoot the 56.35, but it's going to bounce there regardless. There will be buyers, the lower third of bar 7 waiting. Bears now want to close this gap. They want to come down to the 7 open. But I don't think the bulls are not going to allow that. They're not going to allow it very quickly. We're still going to bounce either here or lower before bears actually test the 7 open. But if the bears take out the 7 open, the problem here is this. You got a gap here. This bar becomes a gap bar. So you got 2 gaps, right? So what happens is this. We go up and then we sell. But first, the bears really need to close this gap. So that means they have to close bars around 7, not like 10 bars later, about either this bar or the next bar. So we just bounced at the 50% of the outside bar, mid-range. And the bulls are still wanting to go and test the highs. This was a spike pullback. So I said we're going to test the pullback. We are testing that. But are we going to come down and make a double bottom right here with another bar and then go up? Or are we going to come down with another bear bar and close it? So I'm not sure. I don't want to buy this right now. I'm not convinced that the bulls are strong here yet. We might need to come down and test 35 to 33 area before bouncing. So that would be the second time bears trying to close this gap, and if they fail, then we can bounce. So we haven't truly tested the bar is 8 low, which is the spike pullback and kind of channel. So this might come down a tad little more, perhaps, or if this bar cannot close below the mid-range of bar 7, then bulls will take over right here, right now. And then we could get the second leg up. But it's moving too fast. So I want a bull bar here, but if the bulls cannot show up, then we're definitely going to come down to the 35. At the minimum, could come down to 33. Yeah, so 36.50, not just 35, 36.50 to is 33.50 is where we could test, but if bulls do show up here, then we're going to go and test the highs again. So either there are sellers here, right here, is they want to keep this gap open, and then we come down to the 36.50 to 33.50. Or we're going to start closing bull bars and we're going to go test the highs once again. So that mid-range of bar 7, news bar, is holding. And this bar wants another leg up. But one thing that failed here, bulls could not close this gap. Some will say this gap is closed, but not necessarily. Look, they should have overlapped a body, bull body, right around here, and they kind of failed. So they're buying in the mid-range, is breaking even. So if the bulls give up right here, we can come down. That would form a small head and shoulders with left shoulder, head, possible right shoulder here. But if we take out the left shoulder high, then that's it. Bulls will go higher. They're trying to take out the left shoulder. All right, so that's it then. They're testing the left shoulder, and this bar closes bullish. We're going to go higher. Now they're trying to close the gap. Okay, fine. If they do that, that's great. Mid-range held and the big bull bar, they're probably going to buy the close of this bar. So I went long. Want to see if I could get a little bit more traction from bulls here without collapsing. But I need a bull bar closing above this left shoulder and also higher above the gap area. So gap is totally closed, but needs to close bullish as a bull bar. So then we could continue to go higher. I think the market is trying to get to the 60, 56, 68. Another outside, another inside. Jeez. It's trending up, but overlapping. So that makes it even more difficult. But you got an outside bar, you got an inside bar. So now I'm taking the range of this bar. The midpoint is right here. Okay? So there are probably sellers here trying to prevent a breakout. So I scalped a little bit because of this, but market can continue to buy. And that's the second leg. Okay? So up, down, but I would prefer it to go and take out the 9 high. So that's what I scalped a little bit, but I'm holding for more bulls to take out the 9 high and get above the high of yesterday, or at least test the high of yesterday. So 56.65, I want bulls to get there. But what if we plunge all the way down here? Well, this is still a channel. It's still making way. It's up. So I'm not going to worry about that right now. Bulls want to test the bar 10 high and higher. So they could actually bring market up to 65, 66, 56, 66, and then it could move up to 56.75. We've breached the news bar, and even so now 3 news bars, 7, 8, and 9. Bulls trying to take out the 9 high. If we take out the 9 high, we'll go even higher. Okay, but if we fail to take out the 9 high, we could go sideways and down. So I'm expecting bulls to try with that second leg up to 9 high. So high of yesterday and the high of week are my magnets. So there is, I talked about this gap area, and the bulls failed to close with the 9 body. So it came down, right? Some profit taken there, but this is a spike, pullback, and channeling up. So you got a double bottom here, another bottom, basically 10 and 11, take it that way. So when I see this like a spike and a pullback and the market goes up, right, comes back down, I like to see some kind of a double bottom here and a good bull close. We're probably going to go take that high up, and we're going to make a wedge top before coming back down. So I'm long. I did scalp because there could be sellers at the high of 10 or the upper third, but really good bar. So probably inside bar. Low is where the stops are, and bulls want to go higher. So half that. So if this bar closes bullish, bulls will want to definitely tag the half R, and they will try to scalp there. That's 68.75. We can't even get to the 78.25. So the first target, I mean, it could go to 62.75, 62.50. Could go higher than that, 71.25, 75.25. So yeah, it's still trying to make its way up. But we have to, if we want to make even more move up, higher prices, print more higher prices, we have to take out the 9 high. So that would definitely seal the deal for bulls, but it's just that three news bars, bears tried, or some bulls took profit, whatever. It's just we're trying to take out that high. There could be sellers up here or sellers here. If we fail now, we go sideways down, and then we make a lower high, and then we could start the swing down. So bears could bring market down suddenly to the 10 low or the 10 close. If they have sold 10 close, they're trying to prevent from bulls to taking out the 9 high. Bulls want the 9 high. High of yesterday and the magnet above is so close by. One thing that the bulls failed to do, they failed to close a bull bar above the inside bar. So we need a bull bar, okay? We need a bull bar to go higher. Failure to get that bull bar, we could come down and test the midpoint of this inside bar. So we need that bull bar to get to here, scalp a little, and hold a runner. If the bull bar takes out these new outside bar 10 high with a bull close, then we are going to test 66, 56, 66 very fast. But we need the bull bar. Without the bull bar, market is moving too fast. 12 points. It could plunge 12 points, or at least 6 points. And if you're in with multiple contracts, that could put a dent on your account or in your account. Not very good breakout and follow through. It's failing. So I'm not very happy with this, but bulls have tried, and we are not getting above bar 9. And I'm disappointed, but there could be buyers. Remember, I said if we fail to close a bull bar, it's going to come down halfway, and it's going to look for buyers right around here. If it finds the buyers, then yes, we could go up. But I still need that bull bar. What about bears showing up here? I think we need to push one more time, or it's going to be overshoot, undershoot, wedge top here with bar 7, 9, and 12 high. And the bears want to come down and test the 10 close. But I still think the bulls might show up here. If they don't, we plunge. They're going to buy again, and then that's going to form a lower high. That's the one I will sell. So they will buy again, regardless. And then we're going to probably go up. And if it becomes a break-even event and I start to see lower highs forming, then I'm going to look for a swing setup to take out the 7 low and then get to the open of the day and move way underneath the open of the day. Market could try to close this gap today, but right now I can't worry about that. So I want to see what the bulls are going to do here. They did bring the market slightly to the midpoint of the inside bar, or maybe they already did, but let's see. Let's measure it. No, they haven't really touched it. But they're already getting some buy orders stacked there. It's pushing the body up. But is it strong enough? So there is wedged up here with an overshoot undershoot. I guess you could call it a truncated wedge. So now if this doesn't hold, because bears want to bring it down to the 10. So they failed. Look, they try to get above. They try to get above. What do you think I did there with my runner? It hit my stop. I'm done. It kicked me out. That runner didn't work. So I'm done. So I'm going to look to see if the bears can actually either breach here and continue to sell, or I suspect the bulls will show up here because they're stuck up there. Some bulls will buy and try to break even. Because market is moving too fast, I cannot add to a losing trade. I'd rather to take a losing trade with a break-even plus, or I take a small loss and do not add because ATR is just too big. Average bar sizes are just too big. You have to recognize your constraints, right? You have to recognize your limitations. There's no point adding to a losing trade when you can take a small loss and wait to see how this is going to react. Look, they're buying. They're buying, or you can also measure the outside bar. That's probably the 50% or lower third we're testing. Buyers are probably there. And then they can bring us up and then give these bulls a relief. And if that forms the lower high, I'll be looking to selling that. What if they sell now? Without taking the bar 7 open or low, market is not bearish. It's still bullish. It could still make a new high. But look what happened on the hourly. I said we're probably going to get some kind of a double top and inside bar. At the moment, it's trying to go higher, right? But we may not go breakout. So we could go up, and then suddenly this inside bar today can also be a bear bar, wanting to close somewhere down here. So watch out if we start to get bear bars after forming. This is wedge top, so we need a lower high, double top lower high, and then I'm going to look to see always in short. Always in short might be forming right here, right now, but we need strong bear bars. So first sell, bears are trying to get a second sell, but bears also, they're not stupid. They know the bulls are stuck and they're probably going to buy and try to break even first. So no one's selling with large contract sizes yet. Maybe partially. If there are any bears in the market, I don't want to be the first to the party, but people will sell underneath bar 13, but they're always buyers. They want the test of the close of 10 or the low of 10, but still buyers will not let go that easily. So somewhere around here there could be buyers. Okay, so we are at the lower third of outside bar 10. If there are any buyers, they're here, right here. So it's around the 44.75 to 42, 56.42. They hit some buy orders, so the bar is bouncing, but is it strong enough to bounce it all the way up here to give these bulls stuck above bar 11 to break even? Okay, So you see this right here, this is the limit buy zone. Two red lines, 33%, 21. The way that I've tested this outside, inside failure setups, here, I'm going to get rid of that, right? So I'm measuring this bar and right there. Okay. So now think about, put yourself in the shoes of bulls and they're stuck here. If they buy somewhere here, maybe they bought as early, this is their break even. Maybe they bought somewhere in the middle, this is their break even. So they want market to get to here approximately, okay? Maybe they bought there, so that would be their break even. But no bull bar. So is retail traders, they're not going to buy anything until they see a bull bar. So all I know that this right here is a trap zone starting. It could move down a little bit more and then find buyers and still go up. So this area, starting from here all the way to here, is a buy zone. Okay. Given bars are too big, so it's a large range. Starting here, sometimes you get very quick bounce, but all the way to the trap zone, bulls are positioned here. So they're buying because they want to see price go up. So first I look to see if there are any buyers here. I'm not seeing any bull bar closing. I'm afraid we could actually dip. So we did dip a little bit more, but it's not going up too fast, okay? But still, I have to give a chance to these bulls stuck there. Maybe they bought the close. I'm going to measure the close. Maybe they bought somewhere here, right? So I'll measure that. That's their break even, give or take. It's probably going to go higher than that because some bought in here or some bought at the level. So the top, we could actually reach right there, 51.75. If this keeps coming down, there will be more buyers here underneath bar 10, at the 0%, minus 11, they're there. So market will give you a chance to break even before. And it also has to set up the lower high for swing. So I'm watching this. It's a mess, you can see. And I'm not in it, so because my break even stop got hit, so they kicked me out, which is fine. But I'm also not buying this. Now, if I weren't talking, I would have bought it. I would have an order here, order here, order here. Two of those would be hit, and I'd be making money scalp immediately. So I trade this, but the conditions are too rough for me. I mean, it's 10 3/4. That's ridiculous. Can't take that risk. So it's basically telling you your scalp is going to be 5 points. It could go up so fast or it could come down so fast. It's kind of rough. Bears sold the 13 close and sold underneath and still right now making money. Some bears, I said, we're going to probably test the 10 close. So they're taking profit there. So because some of the machines are taking profit, the bulls are joining in because they want average price to exit out of this mess. And if they cannot go all the way up here, then we're going to get the bears once again. And watch that. That's working out perfectly fine for bulls who want a exit strategy. Are you guys getting this? Do you understand what I'm explaining here? I'm trying to be very scientific. I like to be very precise, and I've developed this a long time ago. And then I watched Al's bonus videos, 15 and 16, and it kind of sealed the deal. Okay, I'm on the right track. I'm doing the right thing. I've been doing the right thing. So now I'm going to stick to these. Now, these are not FID levels. These are my levels, okay? The levels that I have is tested that the machines seem to be respecting for years. Nothing's changed. But I want you guys to see what I'm seeing. You do not have to do any of this. You can simply sell bar 13 and take profit at the close of 10 and be done with it because it's a trading range. But I like to see what the heck is going on because, I mean, let's face it, I'm not the world's most smartest, person in the world. I don't think of myself as I'm the most smartest person. I'm just a retail trader. I just need to see what the machines are doing because, 80%, 75% of market is, if not 90, traded by the machines. If I can understand their behavior, I could trade with them rather than trading against them or just, hey, I'm just going to throw this to the wall and see if it sticks. That's not the way to trade. You'll blow up your accounts. So, and this is an advice long ago. I did watch one of L's presentation and how adamant he was to talk about machines. And I said, look, yes, we're all pattern traders, but sometimes patterns don't work. Okay. So you have to understand there's a level calculated that the machines see. So my job is to see that as well, then decide whether or not I can take a trade. Okay. So this was the second entry short for bears from the highs. They did make money, so now they want a second leg down. Now did the bulls actually take the bait? I don't know, not there, but here if they bought, oh yeah, I mean look at that. Check that out. Huh. So I guess I was right. Yep, it's a TR, so. But it is now head and shoulders pattern. And there is a neckline. The weirdest neckline. Okay, so we're breaking the neckline. Now what's going to happen? We did form a lower high, but we could go back up and then sell again. That would give us a leg 1, pull back, leg 2, pull back, leg 3 before bulls show up again. But once we move underneath the moving average, we can sell. However, I want to point out something. We got 3 bear bars here, but, okay, there is a bit of a gap here. So what will happen is that we're going to probably go back up. Problem here is that that gap is not all that greatly defined. And this is not, it can become always in short, and it's trying to become one, but unfortunately it has to go up, okay? So if you're selling right here, this could bounce on you about 13.5 points. Bears are trying to close the gap. I did say, look, that's the leg 2, or leg 1, pull back, leg 2, pull back, leg 3. And bar 7, open, is where they want to test. So now I do have a really nice gap here. Okay, so if we do take that out with a bear body, you got a gap here and you got a gap here. Okay, so what you're going to do is you're going to expect a pullback and see if you can get some kind of a bear flag and see you can sell it. But you have to wait for that bear flag to form. Now, if it moves underneath the moving average and opens another one, so it starts the gap down here, okay, we could suddenly get this. Okay, open of the day, we move underneath, that gives us a measured move to the downside. Yikes. See how that's, so bulls took the bait. They're like, oh, not bait really. They tried very hard to break even. So they're done. That's your lower high. So now they're selling. So there is now the gap is closed. There's a measured move. That's a give up bar. Yikes. So that's the health R, and the market is trying to come down here, trying to close the gap. But it still needs to bounce. Okay. But it could be now a 2-bar, 3-bar bear flag. But really good job by bears I'm extremely grateful for my break-even plus stop to be hit and get me out of this mess before this has happened. So we are becoming always in short now. We might have already 3 bear bars sideways and down expected, but too big of a bar, it's kind of a trading range. So bulls might show up here like this, but we could also sell that bear flag down. That's my target, but it will bounce a little bit. So I would scalp a little bit here and expect a bounce. If anybody is not clear of what I'm saying, this is a bunch of gibberish to you, or you think I'm delusional, just let me know. I'll explain once again or point you in the right direction with the course material. Because last thing I want is somebody not following. They broke the neckline, but there's also a huge gap. So I don't know. We're probably not going to close this gap, but we're going to go up a little bit. So this is now support. Look, it was resistance, broken, support, failed, second leg. So what happens to that support if the second leg cannot take out the high? Just like yesterday. I don't know if anybody watched or listened to what I was saying. I know I can put people to sleep, but that's a leg, and a second leg fails to take out the high. What did I say to you guys? There's a support here. They're probably going to break it. So we're going to come down with several legs. Now, they couldn't break it, but they've tried, and it bounced. So now look, leg one, leg two, there's a support here. They already broke that support. So good luck, bulls, okay? So what the bulls will do now, they're not going to scale in until they see a bar similar to the size somewhere down here. Then they're going to get in. It could be down here. It could be down here, okay? Then they're going to look for a 80% probability break even, and then 60% to get back to where they got stuck, maybe somewhere up here. So they're not going to scale in because this is kind of a give up bar. Therefore, it forms a measured move. So watch out here. We just took out that bar's low. It still needs to give us some kind of a bear flag here. So it's just going to go sideways, maybe slightly up, and form a bear flag, and I'm going to be selling that. Could sell this, but I just needed to close bearish. Right now, this is a breakout. Needs to get a follow-through bear bar. If it fails to get a follow-through, then it's a breakout pullback, then it can sell. Breakout pullback is going to become your bear flag. So think of it as a most buy or sell climaxes can lead to a trading range, and test of the climax bar low or high, and it can lead to a measured move, right? So here is your climax bar. Failed, turned into a trading range. We've tested it, so now it's trying to get a measured move down. And let me see if I can show you an example. And that's that pullback I've been talking about. Bulls trap the bears. So I did say to take your profit because we have to bounce. And this could have been a 13-point up. And you do not want to be in that. So you have to take that profit and minimize the risk that the price can go up. Okay. So what do I call bar 16, y'all? How do I trade this bar 16? What am I looking for? Obviously, it's a failed breakout. So it's a breakout now. I have to consider this is either breakout or breakout pullback or reversal, right? So if this is a breakout pullback, what do I call this bar? Yes, ATR bar. Thank you very much. It's not a mother bar because 17 already broke its low and kind of breached it. It should have been fully inside. Then yes, I would call this a mother bar, but it's not. So this is the ATR bar, and this is neckline break. So bulls are trying to get back and test that neckline. Okay, so this is a trading range now. So what do? I measure that only the body, right, and I look for a pullback. So here's a pullback. If there are any sellers, they could be here, or we could go up here. Okay, somewhere around here, I expect sellers. And then they will try to bring it back down here again. Now, however, if we start to take out this 66% and then take that out, then I'm afraid market will make its way up to back to the high again. Because its trading range is, they're trying to close the gaps, okay? So here I'll add the levels. This is where I am super patient and looking to see who's going to win this fight, right? Is they should have already sold here, but it could go a little bit more. But if we start to close bull bars above the 66% and the threshold 79, that's why it's green. It's alerting you. Listen, these bulls are closing bull bars now. So chances are they're going to test this climax bars open high, and we start to close here, then they're going to buy, and that's going to be their target. That's going to be their target. So don't be surprised. This right here, big up, big down, confusion sideways. Before anybody sells, you have to wait and be patient. Okay, if you were still selling here and you didn't take any of my advice and alerts that this is going to go against you, exit or take profit. Now, what do? You see that this and this threshold taken out with a bull close, you have to take the loss before it hits your stop or before it hits your stop, because this body did not take out that low. So this is not a good place to put your stop anyway. Your stop should be here. So market will show you whether this is going to resume selling down and get another leg or two, or right here, it's going to give up and it's going to come down. That's fine. Or its bulls are going to close this gap because, hey, big up, big down, confusion, trading range. We're going to end up going up here. You can at least exit and then expect these to be tested. So right now, we're right at the 50%. Okay, so market is respecting to this level. So they just found some sellers. See what's going on there? See now, if anybody's stuck here, nobody actually scalped and didn't listen to me. They're stuck selling there. Okay, this is their break even. Look. But those are the machines selling, because machines know the 50%. So if I were to be stuck here and didn't take any profit, this is where I'd be selling and breaking even right there. Be done. 29.50. We kind of hit it. So it's there. 29.50. Yeah, 29.50. But now it's probably going to go under. Okay, it went one tick under, so everybody got filled. So any bear wants to exit out. Any bear wants to exit out of the market stuck with the close of 16. They are going to take that bait. Now your job. Now step number 2. So we're smart. We're smart. We know what's going on. That is probably what the bears are doing. If this bar suddenly closed above 50% and closes 66, then many bears exited out of the market, no one to sell. So then we could suddenly go up here. But if the bar closes below here, we're going to come down and test here. That could be the second leg, maybe third leg down. And that hasn't set up yet. So your job is to outsmart the machines and not fall in for the traps. So if you can measure and recognize what the heck is going on in front of you, you truly can outsmart the market or survive another day. All right. L has a really good analogy. Is every time I repeat this in my head, it's like I remember and I see myself back in the Stone Age. Let's face it, I'm not a good hunter, so I'm probably a gatherer. It's like, I don't know, like 50 feet outside a cave that I live in. And so I'm gathering stuff, and there are bears out there, okay? So I have to watch. I don't want to be the food for the market, right? I want to win. So in this situation, if I can outsmart them, I can still have a kill right outside the cave. See what I know my analogy is really bad, but today's Friday, so just go with it. But this is right now I'm watching. Will the bulls step it up and get to the 66% and above? They could still sell from here, but we could close the scalp. We closed the scalp. then it's a fair game for bulls. They could go and make a new high. But right here, we have a gap open, and this bar wants another leg and possibly another third leg down. So I want bears to actually close that bar in about 1 minute and 39 seconds underneath this dash blue line, and then come down and take out the 16 close so that we could come down to this target and that target. But what I want is not important. What will happen is what I'm going to follow. So you eat what you kill is what I'm trying to say here. Okay, well, let's face it, not many of us are good hunters, or we hunt small, but that's okay. Just be safe. So, and that starts with understanding what's happening in front of you. So bar hasn't closed. You cannot judge this as bears are exiting out of the market. You cannot say that. There is still 45 seconds for bears suddenly closing that bar below that dash blue line. Bears want to go under open of the day and turn the day bearish again. Because it is a head and shoulders pattern. Don't care for that anymore. Okay, so the bears couldn't close bar 19 below the important area, but now retail traders who are looking for a bear body close to sell. 19 is not all that great, but they could be very well selling that, hoping. Now this time they measure like this, the close of that bar. So their break even is right here. So market can still come down here. So what happened? Bad sell, right? No one's going to sell it. So now retail traders are stuck. So they're hoping that there are some sellers somewhere around 66 to 79. But the problem here is that, adios amigos, this is going up here. And if we get there, we close the gap. And then we end up going up here and closing a bull bar. We end up going up here, but still waiting. So now is somewhere close to the 66%. We're getting some sell orders, but the bar has to close very bearish, okay, in order for it to come down more. So I sit and watch how far the sell orders are scattered, starting here, there, maybe even there. So you could go there and finally start to sell, but I don't know. It may not sell at all. So your job is to stay out of this pullback, deep pullback. But you can get a deep pullback, and then it could still get a leg down. So I'm now watching and trying to figure out what will they do. If this bar closes with a bull body is above 19, they're going to buy it. But if it closes a bear bar, they're going to sell. So I need a bull body is taking out the 19 high. So then they will probably gonna buy. I'm not saying taking out now, it has to close. If it fails to take out this 19 high with a bull body, then no one's going to touch it. So it's just going sideways at the moment. First sell 19, bears want a second sell, so they might allow this bar to go up. But closing the gap around here, bulls are going to be, okay, we've done a terrific job here, so we've got to get the market up here now. So we need a bull bar here. I put a buy order above 20 did not get filled, so is waiting. But now this is too much, so I canceled it, so now it's coming down. That's the second sell, so now bears want to sell. So that's good. They contain the bulls under the 66%. That's great. So now they need to close this bar. That means they're coming down to that average price. So they got to the average price, okay? Anybody who's stuck up there still not able to fix anything. Maybe they did, I don't know. Let's say you're stuck there, you buy maybe above. Nope, you couldn't. Look, it's even if you bought the close of this bar. So that means they're going to have to scale in somewhere down here if we take out the close of 16. So if this bar now closes somewhere here, bears could sell the close of that bar, and then they're going to target the 16 close. Okay, so now bears are getting that leg. So can there be any bulls here? Well, we need to give these bears a break even, is right here. So I'd like to see bears actually, but if we get there though, we close a bear bar, market can turn down more. So the bulls are trying to prevent that, is so they can buy underneath the moving average once again. But you could see, right, they did sell. Would have been better if they actually touched the 66. But now if this bar closes bearish, other bears will could sell again. So anybody who's stuck, maybe somewhere around here they sold, or they sold here, it doesn't matter. They sold this bar, right? And they got their break even. But that was a terrible bar. Now this went up. I don't like to sell a bull close in a situation like this. But if you had a sell order there, sell order a little bit under, whatever. Either way, you got a break even. But the real break even is here. So the goal is for bears to bring market to here. So I want to see where that bar is going to close and how it's going to close. So we want to move underneath open of the day one more time. If the bears fail here and suddenly we get bull bars getting above the second sell, okay, and the trigger bar 21, then bulls will take the price and the market up here. So that means, okay, so the retail traders sold are actually is breaking even right here. So it's still, I still have to wait. I want to buy if this fails, but the gap is still open. I don't see that gap close. Market wants to test this neckline. It's trying to go up to the threshold and to here. So if we actually close a bull bar right here, bears exited is, so now you have a leg one, leg two, second sell failed, so now it's going up. So we probably have now a measured move or 1 hour. So market is trying to get there. All right, so we close. So the target is now, if we can get to, is the 56.49 to 57.50 roughly. Bulls need to get above 49. All right, excellent. I actually bought and I'm trailing my stop. Now I want bulls to close a bull bar and accelerate up here, because they kind of earned it, but they still have to close a bull bar. Now look what they did. They actually broke above the neckline. A head and shoulders pattern should not be allowing such a thing. In fact, now bulls want to test that. Okay, so if we test and close above it, we're going to go higher. So, and then we could make a new high even. We could even get to the high of yesterday finally. So that would be 66.25-ish. But first we need to get to here. First we need to get to here, break above it, and then here, 1R, and then here. Bulls need to close the bull bar, then we're going to get there and there and there. What happens if we can't close a bull bar right here? Can the bears still sell? I think those bears exited out of the market already. So all we need is violate this neckline and become bullish again. So close above it, get up, and go higher. I just put the neckline there, so for this head and shoulders pattern that is now becoming invalidated. Bulls trying to close a bull bar is continue to go higher. I'm going to scalp here if I can get it. It's a trading range, so we're going to probably test the highs, but we could trap the bulls there, so be careful. I want to scalp the 57.50 trading range, so we're going to probably test the highs, but we could trap the bulls there, so be careful. I want to scalp the 57.50. And bulls kind of earned this, so hopefully we could get there very quickly. So we got to this one. We need a bull close. We don't want this to collapse. Okay, bulls just failed there. We needed that bull body closing above the left shoulder. So this can still come down a little bit, but as long as we're above this neckline, and we could still close a bull bar here, but we did reach that target, but I have more targets, so I'm still waiting for bulls to buy this pullback and get us to here because they earn it. This is their first targets and next target up here above high of yesterday. So if you did a hold and you didn't exit out, you didn't scalp anything, you didn't listen to anything, market gave you a chance to break even. So somewhere between the 66%, 50%, you could have sold and gotten it before this bar closed. And if you didn't and you still held, thinking market is going to come down here, you had to exit above bar 21. Because if you didn't exit above bar 21, chances are you have blown your account. So I did scalp there just in case, and we failed. So I kept scalping more and more. I'm still holding one more contract, waiting for bulls to get above this line. But if we start to now come down, I'm going to exit it with that. Well, I'm going to be forced to exit. It's going to hit my stop, break-even stop. So I'm still holding a runner. I'm still holding for this target. Because gaps closed, there's a bit of a gap here. They're trying to get up above the prior high. Today is all-day event, so Brad Wolf will come in after me. So don't go anywhere. What this is a institutional pattern. Came down, right? So now bulls want to go higher. And then they might even buy the pullback if we can take out that high. But because it's a trading range, okay, so this is basically a leg in a trading range. What happens if we go above the prior high? Well, we could still trap the bulls there. So you still have to take some profit if we get above this level. I'm not very happy with the bulls right now, but they are doing what they're supposed to anyway. So it's just, I'm going to give it a room. We could have this. Go up, make a new high, come back down, buy again, and then come back down and close near the open of the day. Don't think this is us, but could be a trading range day. Big up, big down, new high, but wedge top, big down, not able to make a new low, then traces back up 50% of this bear leg, forms a bear flag, but ends up selling into here or somewhere open of the day or under, and it goes back up to the open of the day. It's a trading range, so the open of the day becomes a magnet and eventually closes around there. We need them to break this and get to the next target. And it's not breaking above. So are we done with this? Are we going to come back down now? All the way down here? Well, we might. Now, because this is second leg up in a trading range, okay? So if the bears start to close these gaps, then we come down to the 50% of this trading range, right? But the gap stays open, we might still make our way up. What about this day becoming a one big double top and a neckline 17 and the market continues to sell rest of the day? Could that happen? Yes. So you got a wedge top here, maybe a wedge top there, double top. So this is what it would do. It just come down, make a lower high, take out this neckline, okay, with strong bear bodies, then a pullback, market can sell. But this is such a large range. I don't think it's, now the ATR is big enough. So the average true range of these bars are large enough to move the market very fast down to here. It could happen, but you have to see bears taking out these lows. And then keeping the gap to the moving average open and then selling further down. So they will close this gap if that starts to happen. So is right now we could still get above this, but it is failing. This is the second time bulls try. If this bar now closes bearish, they're going to try to close this gap and come back down to the bar 19. What about the bears? Didn't get their chance to bring market down to the 16 close. Can they sell here? Well, this is a trading range. It is possible that they could. But right now we haven't broken this again, so we're stuck in this wedge, and we can still break out to the upside. Remember, today's Friday, could make some wild moves. Anybody bought here still holding. They want the prior high test. Is anybody bought here also scalping here because they know flags at the upper third is of the trading range highs can fail to break out. Even if it looks like breaking out, it could actually come down. So it is kind of forming a small flag here, right? Up on this, down on this, up on this, down on this. We need another down. We're still stuck in that little wedge there. And I think they're deciding what to do here. Bulls want to take out the prior high and test the high of yesterday. We're so close. But that starts with taking out this right here. And we have not done so. This is swing. So bulls are still swinging. That's their first target. We're probably going to get that. It's also measured from this body rejection. So it's confluence area, and that's what they want. That's why I'm not removing that second arrow because I still think that we're going to test there. But I'm not very happy with the bulls. They should have already started to buy. So it's a leg 1 pullback, leg 2 pullback. We just need the leg 3 to start printing. So patience. You'll know it if it fails. That means this line needs to break with bear bodies. So bulls see a leg 1 and leg 2, and they want the third leg. Bears see leg 1. Where's the leg 2 and the leg 3? If this is a trading range day, bears need to print more legs. So now if the bulls take out the highs, we might actually make new highs, but I don't know yet. So this is just still deciding what to do. But if you divide this, okay, what you have for today into 3 sections, we're at the upper third. So that's a sell zone. And that's one of the reasons why we're struggling here. But we start to break that bar 7 high. We can go higher. Now, bears had a chance to sell. They took out the news bars low, but it failed. That's a breakout failure. Turn into a reversal, right? So, and they had their chance, but they're stuck. So this is a good place for them to sell as well. So it's a still trading range trading at the moment, which makes it even more difficult. Bulls trying to turn the market strongly bullish again. Is they have to close a bull bar. 2 bear bars, everybody's hesitating to buy above 25. Plus its flags fail at the top, so it's just confusion here. Bears want to sell and bring the market down and under the moving average. But that's the 50% of this trading range. Probably buyers will be waiting there. Okay, so the question here, what BTC course video does L use ATR bar language? There's none. There's no such thing. However, L looks at the bars as possible trading ranges. So I apply L's trading range concept. If a bar like this, not getting follow through, that's a failed breakout and reversing back up. You have breakout bars, you have failed breakout bars, and then reversal, okay? So then what does this mean? That means I'm looking at this as a one big trading range, and I'm dividing this into 3 sections, 33, 66, and then there's a half that L pays attention. So 33, 50, 66, okay, and 100, 0 and 100. So what I'm doing is that if bulls close the gaps, okay, a big bar, they're closing the gap, so that means they're going to get a breakout. I see the breakout, so I'm taking that 1/3 and projecting up for a scalp. 2/3 is a swing. 3/3 is measured move. So that's it. So I'm taking that within the concept of trading range trading, and I'm looking for a breakout. Surprise bars is low probability events. When they happen, if they get follow through, then you expect leg or 2 and a measured move down. This bar is a leg in a trading range, and in fact it's the second leg down, so it's the failure of a second leg breakout. It's a trap, so they trap just like bulls, okay? Here second leg trap so now it's coming down. So it's, what did I say? It's a big up, big down confusion. We're going to go sideways, right? They couldn't sell. They tried, but this bar closed. You could buy 1 tick above. So that now we're getting a breakout. So I'm going with what I have calculated, and this is a scalp. Or you don't have to do any of this. You don't have to do any of this, okay? Just measure it, and I even put it on the chart as well, right? So that's your 1 hour right there. And here, surprising the big bar, did they get their measured move? Not from there, definitely from here, right? So that's a measured move, but it's a trading range, so it failed. If you actually measured from here, right, that's a failure, so it's reversing back up. You got to give up at some point. 2 bull bars, pull back, that's a swing. But the problem here is that you're stuck in a trading range. So it's probably going to fail up here. We still haven't closed above this line, a bull body. It's a problem. Bull flags fail at the top of a trading range. They fail to break out. Please remember that. This is no different, but we're so close. So probably machines bought the close of this bar and scalped. So this could be that flag failing right here. So disappointing, but it isn't the end of the world. You could have still. Now what happened there? Well, I want to take a look at this again. We failed to tag it, but that doesn't mean that we're not going to. So as long as we're above the threshold and we stay above it, we could still go up. It's becoming an outside down bar and flag failing, but bar has to close, so 30 seconds. Bears wanting to come back down to the moving average. So that would start the second leg down for them. But there are probably buyers here, because think about it. Here's a trading range. That's the 50%. So there will anyone who's stuck here that they were looking for their targets, disappointed. So they're going to try to buy around the 50%. Another way to measure your trading range, exclude the wicks, and that's your 50%. And I'm measuring from here. The bar 1 close and to here. Okay, so this is accelerating. What would you do here? We closed below the threshold. Now we're coming down. They probably going to sell this bar. So you exit. You're done. If you're still holding, I warned you several times, this could fail because of flags, bull flags 75% of the time. They're going to fail breaking out at the top of a trading range. So there was always that problem and then not able to close a bull bar above it. They tried once, bears tried once. Bulls tried twice, failed. What do the bears do? They take over. So they're going to sell the close of 27 now and come down 33%. That's a 66% drop. So then what do? You exit. You see this bar closing like this, you just exit. Because you already bought here, right? Or you bought there, you scalped there, now it came down. You really didn't lose much if you exit with bar 27. But if you hold it, now you're hoping someone from underneath the moving average will buy and will give you some kind of a relief. Maybe you bought that close, you bought the 50%. So what you're looking for is market reaching there. Or maybe you bought here. You put a buy order there, the 50%, you put a buy order here, then this is your break even. You want price to go one tick above. I see bar like this. I'm not going to hold for that target or further target and whatever. Targets are targets, but price action will do whatever it wants to do. It's a trading range day. Now, what can market do here? It can suddenly start to sell. Remember I said we could get a double top neckline. Bears want to take out this neckline. And if it starts to sell fast, we could close this gap. We could come all the way down to the close of yesterday if we move underneath the open of the day. But before that happens, bulls will do everything in their power to break even first. So we now have a somewhat of a triangle, right? So I'm going to clean this up again. So we're going to go in this sideways. So those bulls who were stuck there and they are now buying again around the 50 to 66% down and getting a break even. Now, are we going to go up, or at the apex of the triangle, we're going to fail, these bulls are going to exit, no one there to buy, then we're going to come back. Are we going to come back down and start selling underneath the moving average? It is possible that we could do that. It's 11:48 a.m. and I need to be done at noon before Brad Wolf comes in. So if you have questions, I open the question box on the GoToWebinar. I'll take a few questions before I leave. So you needed to exit with bar 27, or you needed to scale in at the midpoint or the lower third of the trading range. Here, I'll do that again. So if this is your trading range, this time I'm going to take the full range extremes, okay? The high to the low. And I'm going to divide it into 3 sections. If you were a bull stuck up here, even though I kept saying this is a trading range now, there are probably sellers here. And we're not able to take out that high. That was the head and shoulders, left shoulder. So that means it can't come down, right? I said 1 point, bears want to bring it down to the moving average. So is here, we're in the middle, right? That's the 50%. I said buyers are probably there. If the wicks are too prominent, okay, I like to exclude them. So I will take this as my trading range. Now look at that. They had a buy order right there. It actually breached 1 tick under, 1 or 2 ticks. So if you are stuck up here, you buy here, somewhere in the middle, you get a break even before this collapses back down to here. So you should always be drawing on the charts, trying to figure out, establish what it is that you're trading first. Big up, big down, confusion, sideways and up. So failure to break out, bear breakout bar, failed second short. Okay, so what does this mean? Well, that means it's going to go back to the climax bars and it's going to close the gap. Did the bulls do that? Yes. They get a break even? Yes. Now, is this forming a flag? Yes. What happens to the flags on the top of the trading ranges? 75% of the time, they fail. It's in the webinar presentation that is open to anyone. You don't have to be a course member to access it. It's on the BTC course website. I talked about it several times. So now it comes back to, if this is the triangle, the heart of the triangle, which is apex, right? The center of the triangle. Or if it's a trading range, the 50%, right? So bulls did buy, had a break even, no bull bar. Now this can actually come down to the open of the day. If we start to gap down suddenly, okay, I'm worried about bears now taking over, bring your market down here, maybe even here, okay? But I think somewhere around here, bulls are waiting. So we could end up coming down here, then bouncing. That means neckline has not taken out. Okay, so that puts us back to the apex of the triangle once again. So what do? It's very simple. You just measure it, okay, and then if we do come down, and then if we do bounce, most likely there will be sellers here and they can sell. And today is difficult. I mean, look at the bars. The average regular scalp is like 10 points now. So the swing is now, average swing is 20 points. So market is telling you, yeah, you can scalp about 9 to 10 points. Gosh, that's rough, even with one contract. You know, if it goes against you, you'll be losing a lot of money. So maybe trade small with micros, with 2, 3, 4 contracts, well, that's about it. How do you do your trade sizing with respect to runners and taking profits? In a day like this, I employ only up to 2 or 3 contracts, and that's it. And because I've already tried it, and at one time it really went against me, and I saw that how much damage it can do. So just you lower it. You go with today, a day like this, okay, is you don't need ATR. You can simply, just remove it. But then you have to measure these bars and get a feel, okay, this is a 14. My gosh, it could go another 14 points up, right? So it's almost 30 points. So look at this one bar. It's almost 20 points, okay? So regular, I mean, can you go in there with like 4 or 5 contracts? No, that's suicidal. You just only use 2. Or if you really want to trade with more contracts because you have a big account, then still you have to manage the risk and maybe go to micro. Okay. You're in a trading range. Legs will fail at the upper end, and bear legs will fail at the lower end. So if you buy, you want to buy at the low of the trading range, lower third. You want to scalp in the middle and then leave a runner into the upper third. That's all. And then you always expect failures, any kind of flag formation to fail after the second leg. That's the sign of a second leg. Bulls got a third leg. This went up slightly, but it failed. So now bears are selling with the second entry short. Is if you were still long, waiting for your targets to hit and you're not getting it, I try to give you guys a hint as much as possible. We are not closing above this. It's important. So that means is bears see something, okay? And this happens, you exit immediately because they will sell the close. They will sell one tick under. They will sell. Now, bulls try to fix it. They failed. So no bulls probably left here. Where can this go? It could go down to the 21 low. It could come down even here, okay? So you're stuck in a triangle. You're at the center of the triangle with bears. Now leg 1, pause, leg 2. Okay, look, more tests of the lower third. So now they want to close a bull bar above it. If they do, they might go up to here, upper third, mid-range. Actually, no, I'm sorry, I'm wrong. That's the boundary line. So let me add the template. That's going to be a lot more clear. Okay, so is upper third, mid-range is here. We're in the trading range, center of the trading range, or the mid-range. So is bulls need to close is above the 50% to go up. If not, we can come down more. Bears need to close below this, and they can drive market down to here. And you're at the apex of the triangle. Bears want to test 21 low. We are clinging to the moving average. We haven't gapped down from the moving average. Is if 29, you consider 29 as a gap down, but look at the bar 30. It's still clinging. So there could be buyers here. But we take out the 29 low, close another bear bar. Because it's trading range, then the open of the day becomes magnet. Bears want to move underneath the open of the day, start selling, and close the gap. Now, I don't know if they're going to be able to do so. Right now, we have a trading range, trading with market trying to come down to the open of the day. 21 low is their target. Happens to be open of the day. Those bears will start taking profit right here, or scalping, I should say, not taking profit, but taking some profit. Is they want a test of this. And if we start to take out this, I'm going to remove that. I look back 4 bars, 20 minute, because it's an intraday. Why is 7 high important? Is I think you missed it all, because that was head and shoulders. Okay. Sold is failed breakout. If a head and shoulders is a bear pattern and it's not breaking down, what do you think it's going to do? It's going to go right back to the left shoulder. If the left shoulder holds it, then you know you're in a trading range. It's probably going to come back down here. Bears are stuck here. It's a great place to sell, okay, after watching bulls try several times. Sell and hope to bring it down to that bar that trapped them, right? 17 trapped them at the close of 16. So you're in a trading range. So now bulls wanted to violate this and test the highs. I really held my hope there, but at some point you have to read the signs. One try, two try, even the third try failed. So you got to exit. There's nothing closing above the left shoulder. Then it's gonna, bears are trying to resume the trend and they're trying to come back to the 16 close. First to 21 low. So this is still a buy zone after all. So we're probably going to test 28.50. Possibly open on the day even. All right, it is noon, everybody. I am done with this week. You all have a great day. Don't go anywhere. Brad Wolf is about to join. Just give him some time. It's lunchtime after all. Please study this weekend. Is trading range, trading, so on. Your patterns is understand how breakouts and how they fail with second legs, what happens next, so and so. All right. Have a good weekend.
If you can hear me, can you give me a thumbs up in the Discord? Okay, never mind the talking. It's showing that the mic's working. So perfect, loud and clear. So give me 1 second. I'll share my screen. Lots of trading range price action today. Always in short. Strong enough breakout down to 31. Probably going to get a second leg. However, bottom of a trading range. If I had to pick a direction, I would be short. At the moment, I'm flat. My last trade was selling below 27, and I got out at the close of 16. I thought about holding part, but this is a trading range. As you know, I typically trade always in. And the way I think about always in is first, I think about always in the standpoint of major and minor always in, or major and minor reversals. So when the market has when the market's in a major always in trend or always in direction, that implies the market's in a strong trend. Strong trends take a lot of energy to form. So obvious examples, let's just get rid of some of this. Obvious examples of strong trends. Let's just scroll through some of the charts I have. This is an obvious example of a strong trend. Strong breakout below the moving average and lots of bars below the moving average. So clearly we're trending. This is not a strong trend. When you're trading, it's really easy when you're looking at someone like Al, who's had, at this point, far more than, maybe 40 years of trading experience, if not at least, 35 years of trading experience. And when you look at someone like Al, it's really easy to listen to Al mention how these really finesse things about the chart. And what I mean by that is he can go to an extremely deep level of understanding of the chart. And what traders end up missing, and you can say the same thing with the video course. The video course has, over 100 hours of information, and it's a very deep amount of information. But there's certain principles, you can call it first principles of just trading or markets, however you want to define it. And the point I'm making is when you listen to the video course, the single most important thing to understand is context. The second thing to understand is the setup. Now, how do we define context? When you're trading and you're looking at a chart, you've got to have subconscious natural reactions. What I mean by that is, think about it like you're flying a fighter jet. You have to have those pilots are trained in a certain standard operating procedures where they subconsciously know what to do. So when you're thinking about context, the single most important thing you have to learn how to do is make the decision on context the exact same way every single bar, every single trade, because that trains your mind into thinking. Ali wrote an article, most of you have read it, if you go to the Brooks Trading Course blog, it's Guest Traders, Steps to Becoming a Price Action Trader. And he talks a lot in there about subconscious learning. And the way you learn something at a subconscious level is you have a muscle memory to it. So for instance, if you're driving a car, most of you, just about probably everyone here, puts their seatbelt on the exact same way every single time without even realizing. And that's because our subconscious mind has taken that over. We don't have to think about it. You probably have the same process you follow from putting your seatbelt on, starting the car, backing up, going forward. It's all the same. And the benefit to that is it allows your mind to think further and further. So let's talk about context. What do I mean by that? Well, for one, it's possible 2 legs down, 16 and 32. Micro channel from 27, so it's always in short, but the risk is big for the bears. So there's no way I'm selling with a stop above 27, therefore my stop's closer. I can put it above a bar like 31. I can exit above 32. Here, I'm flat, and that's because I really don't want to risk this much. Even though I think there's probably sellers above, we're in a trading range. So let me go back to context. When the market is I think about context with the moving average. And what I mean by that is, to me, the moving average is the single easiest way to think about context, for the simple reason that the market is, if someone says context is everything to the left, that's true. But there's one thing on a chart that can explain context in a fraction of a second, and that's the moving average. The moving average, if it's above, if there's 10 or more bars above or below the moving average, I call it a trend. If there's less than 10 bars above or below the moving average, I call it a trading range. So my natural thought process with trading is the market what's the context? I immediately look at the moving average. I see the moving average is flat. There's not 10 bars below it. Therefore, we're in a trading range. Next, I think about, so that answers question 1. Is this major or minor in terms of always in? It's minor. And because of that, I start thinking about leg counting, because leg counting is critical when the market is having minor reversals. 2 legs down, sell off 16, pull back, second leg down, 32, possible second leg trap, possible 3 legs down, 1, 17, 32. So that makes this a little bit more risky in terms of trading down here. This is major. Lots of bars above the moving average, at least 10 bars above the moving average. In that case, so step 1 in my trading is, for always in, is this minor or major? This is major. Therefore, the way I view it is everything's going to be minor and we're going to go higher. And what that means is leg counting to me is less important. So even if we have a wedge top right here, I'm still, even though I expect a pullback, I'm still expecting buyers below. On a day like today, when I see 3 pushes up, 18, 22, and then 27, there's no way I'm staying long if I am long below 27, because it's a trading range day, everything's minor. Someone asked, can I repeat the 10 bars above the EMA theory? It's not really a theory, it's just a number of bars. If the EMA shows trending behavior, if you're getting a lot of bars above or below the moving average, then that's a sign that there's a dominance, there's more traders buying above or below, buying above the average price or selling below the average price, which means they're paying a premium or they're selling on discount, and that means there's momentum to the market. I chose 10 bars because it's a reasonable number of bars. So the market, we're in a trading range. And because we're in a trading range, someone also asked, could you clarify if you're using the most recent 10 bars or just 10 bars over the whole day? It's just the past 10 bars. So here, this is bullish, but it's 10 bars up with a lot of selling pressure, and look to the left, yesterday's high. So there's added risk that the market is probably going to fail up here. So probably sellers above 32. Bulls, you can see the bears did something important here. They prevented 32 from triggering. Bears, they're trying to go outside down. The bears are hopeful that we're going to break out of this range and fall for a measured move. And that's possible. Obviously, if the bears are really lucky, they want the market to close below yesterday's low. I don't think we will. We've had a lot of buying pressure. And until we break far below, this makes me think we're probably going to go lower. Now, I talked about selling below 27 and exiting at the close of 16. And if I was trading traditional always in theory, my stop would be above 32, either one tick above or maybe an average bar range above. So in theory, the always in bears are still short. Bull bar, 33, it's an inside bar, so it's a low one. And typically the expectation of a low one is a pullback followed by trend resumption. Here, I'm not willing. The issue, even though it's a micro channel, part of my concern here for the bears is you're low in a trading range. And that makes me think we may end up going more sideways here. What about buying below the 33 low? Betting that this is a bad low one? I suspect traders will. But the issue is we're getting a lot of bear bars. And that makes me concerned that the market is not going to go straight up. What are the chances the bulls who bought the close at 32 and bought more near the bottom of 32 are going to make money? The reality is I suspect they probably will make money. Why? Because we're in a trading range. Until we break out of all the bars to the left, chances are we're going to be mostly sideways. So there are more buyers or sellers below the 32 low and the 33 low. Realistically, there's probably more buyers below the 32 and 33 low. However, those traders buying below 32 and 33, they're likely scalping. Yes, it's the bottom of a trading range, but with it being a micro channel, that increases the risk that the bulls have to make the market go more sideways. I did buy the low of 33, and I have a target I just got filled at 23 even. Why was I not willing to hold? Because it's a micro channel. I do think we're going to pull back, but I'd rather see more buying pressure if I'm going to start buying above bars. Now, always in. Let's say I'm a bear and I'm short. What am I going to do above 34? Well, realistically, if I'm a bear and I'm always in short, I'm probably going to exit above 34 because of what I mentioned earlier. We're low in a range. We have 3 pushes down, 1, 17, 32. So the odds are we're probably going to start going sideways. And the risk reward is bad for the bears. If you're a bear, are you really going to put a stop all the way up here, 27, and stay short above 32? Probably not. And the reason is, if you had to pick, is the market 40? Is there a 40, 50, or 60% chance that I sell right here, put a stop above, and I'm going to make 1 times my risk? Obviously, it's a lot closer to 50 than it is 60%. And because of that, you cannot put a stop up here. So a lot of traders will be faster to exit. They may exit above a bull bar closing on its high. They may exit above a series of bull bars closing on its high. The bears have done a good job with the selling from the 27 high. And it increases the risk that we're not going to go above the 27 high, but we could easily pull back 50%. 15-minute chart. This looks strongly bearish. 3 big bars down. Let's go to a 45-minute chart. 45 minutes is a multiple of 3, so it's 3 15-minute bars. This bar closes at 12:30. Excuse me, this bar closes at 11:45, 20 minutes. So in the next 5 bars, if the market reverses up somewhere up here, that would be a disappointment bar for the bulls. So at the moment, I'm flat. We're low in the trading range. I like trading always in, but always in, I always think about if something is minor or major when it comes to always in. And because we're low in it, because it's a trading range, therefore everything's minor, and we're low in the range, I become less willing to sell down here. I'm not thrilled about buying. And the reason is because it's a strong enough leg 1, we could still get a second leg down. So if anything, I'd rather wait and see more buying pressure before I'm looking to buy. I've opened the question box, and I will review questions later on today. For those of you that are new, my focus is always in, so swing trading. And you may hear me talk less than others in the room. And the reason for that is, while there's a lot I want to say, I really want to focus on the overall always in direction. And my concern with answering questions during the day, well, I know obviously the person asking the question and some of the listeners will find that valuable. My concern is it will take away from explaining the always in. I really want traders to understand always in and stop entries. I really want traders to understand context, the moving average. If we're above the moving average for more than 10 bars, it's a bull trend. If we're below the moving average for more than 10 bars, it's a bear trend. Obviously, 10 bars is a number. It's a generality. And it's very dependent upon context, but it's a starting point. If the market's in a trading range and the moving average is flat, I'm way more interested in counting legs. I'm not going to trade the third leg. So on days like today, I bought above 21, taking a chance we break to the upside. When 22 closed as a disappointment bar and 23 closed as a bear bar, I just closed the trade for a small profit. Why? Because it's 2 legs up. We rallied on 20, pulled back 21, and now we have a second leg up here. And whenever we're in a trading range and there's 2 legs up, I become very much disinterested. The only thing I want to do, if I'm buying because of the momentum. I'm not buying because the market is obviously extremely bullish. So if the momentum is not there, buying 21 and the momentum starts to stall, I'm going to get out. Why am I not willing to buy above 26? Because that's a third leg up. You can see there's one thing very fascinating that the bears are doing right now, and that is they're preventing bulls from triggering the buy. So in theory, theoretical bulls that are always in bears theoretical bears that are short, they have a stop above the prior bar. And what do you notice? We're not going above the prior bar. That means the market's in a 9-bar bear microchannel. And that increases the risk that we get a downside breakout. Second entry short, but what do you notice about 35 relative to 33? 35 is actually allowing the bears to get in at a better price than the low 1 traders. Whenever you have a second entry and it's at a better or more advantageous price than the other entry, if you think about it, the low 1 bears, 33, they took the risk of selling the first pullback. And now the low 2 bears, 35, they waited for a second entry. And you have to ask yourself, why are the low 2 bears, 35, getting a better price when they waited. A little bit different here because of the micro channel. So that is a big positive for the bears. What happens if we reverse up 37? Well, then you have an implied wedge, 32, 34, 37. So always in short, and we're breaking below. You can call it a wedge, but more importantly, it's an overall trading range. Why am I not selling right here? Because I'd rather see a stronger breakout. If this is going to become a strong trend and we're going to get some kind of measured move, so if this is in essence a double top and we break below the neckline, something like this, if we're going to go all the way down here, there's going to be plenty of time to sell when the market's clearly breaking out to the downside. So that is why I'm a little bit less interested in selling right here. You can see, I'm going to remove this for now. You can see traders buying the 34 low. So what do you notice? Bulls who bought the close at 34, buying more below 34. We're around the midpoint of their average entry. Are those bulls who bought the close at 34 and the low of 34, are they going to get out? In other words, are those bulls going to get out, break even on the entire trade, which is around the midpoint of this bar? Midpoint of the bar is 18 and a quarter. Or are we going to get out are the bulls going to be able to get out at the high close of 34? I just realized I was on mute. I hope could everyone hear me talking a few minutes ago about the low 133? This would have been probably maybe a minute or two ago. Okay, great. I just wanted to make sure. I couldn't tell if the mic was muted. Anyways, part of my issue here for the bears is risk reward. We're getting too much buying pressure at the low of the day, and I don't think many traders are going to be willing to put a stop all the way up here. And because of that, if we start getting bull bars, you may get more and more bears look to exit here. It's common to get micro channels in trading ranges and end up failing and leading to deep pullbacks. The general expectation is whenever you have a micro channel, 27 to 36, usually sellers above 36 and another leg down. In this case, bottom of a trading range. So this is climactic behavior. So there's added risk that instead of getting the second leg, we get a deep pullback. I think always in bears, I would get out above a bull bar for sure. I think some will get out above 36. This is what I was talking about. A strong, a sharp, a maybe possible sudden reversal, 37. So the bulls who bought the 34 close and bought more below 34 are making money. They're at least able to get out break even. And that increases the chances that we're going to get a couple of legs sideways to up. What's the chances we go above 27? I think it's pretty low that we're going to immediately go up to 27. If I had to pick, we're probably going to rally for a couple of legs, and then the market's going to go sideways and decide, do the bears need a second leg down after the sell-off to 36? But always in bears, I would get out above 36 or 37. Too much risk. We get a couple of legs sideways to up and test the moving average. Low one short, but probably buyers below. Not a great sell for the bears. Too low in a trading range. A little bit of a surprise, 39. Strong enough bar, we may go a little bit lower, but possible expanding triangle. Not a great shape, but the point is, this is the risk that the bears face. 3 pushes down. We have an expanding range right here. So yes, strong bar 39, but what leg is this? I'd rather big bar 39. I'd rather wait and see the follow through if I'm going to sell. To me, too much risk that 39 might be a trap, trapping bears into selling low in the range. And that makes me suspicious that instead of 39 leading to a strong breakout, it's probably going to go more sideways. Bulls, the risk for the bulls is obviously we have a double top, and we've broken below the neckline, bar 17, and then we might fall for a measured move. So 39, especially if it closes on its low, and 39 being a bear bar, I think it's better for most bulls to wait and see what the follow through looks like. A little bit tricky to be buying 39, but as far as selling, I have to say I'm more interested in, well, that's a problem for the bulls. I have to say I'd rather wait and see the follow through after 39. Rather wait and see the follow through after 39. Good bar, but not good. Good bar for the bears, but not great context. Obviously, good selling pressure since the high of 27. So always in short, but I'd rather wait and see what the follow through looks like below 39. Bulls, they'll argue that 39 and 40 is a failed breakout of a bull channel. So they want this. They want a bull channel, failed breakout below it, in other words here, and a reversal up into the channel. Bears, they see this as a trading range, and they want a successful downside breakout and the reset of the leg count. In other words, downside breakout and a measured move of the opening range in here. I think more likely we're probably going to go sideways and pull back. So at the moment, I think the bulls who bought the 40 low or the 38 low are probably going to make money. Always in bears, if 40 is a bull bar closing on its high, I'm going to get out of shorts. I would get out of shorts. Too much risk. We get a couple of legs sideways to up and possibly test the 38 high. Not good for the bears. I would get out above that bar. Possible failed breakout of the wedge, 32, 36, 39. Possible failed breakout of the bear channel. And it's realistic that we could test all the way up to the high of 38. Limit order bulls making money below bars. And the risk reward is getting bad for the bears. If you're a bear, where's your stop? You're probably not going to put it above 27. And the reason is, the easiest way to explain it is this. So putting a stop above 27 would be the equivalent of this trade right here. What's the probability that the market is going to go all the way to 55.70 before it goes somewhere up here? And at the moment, I think there's a 60% chance we're going to pull back before we go all the way down here. That means that traders instead will use a tighter stop. Tighter stop, a logical stop would be above 38, although I think there's at least a 50-50 chance we go above 38, maybe more. And that's why I think a lot of traders get out above the 40 high. 40 is the midday mark for the day, and therefore you have to be prepared for a possible midday reversal. I am long. I bought during 39, and I took half of the trade. I took more than half the trade off right here. It was more than my actual risk. And I initially had a target to take everything off at 38, and I took a fair amount off just because this bar is starting to stall. But I still have a target at the 38 high. You could argue that we'll get a couple of legs sideways to up, and I could put a stop higher. But trading range mentality, and therefore I'm fairly quick to take trades and either wait for a couple of legs sideways to up and get out, In other words, I'm fairly quick to get out of trades. So far, this bar is looking good for the bulls. This might be the low of the day. At 42, you can see something important happened with 42. The close of 41 is 19 and a quarter, and the open of 42 is 19 even. So, and 42 doesn't have a tail below the bar, and that's a sign of strong buying pressure. I'm flat. I had my target at the high of 38. I think this is going to go higher, but my tendency is to wait and see how 42 looks. It's at the moving average, and I'd rather wait and see how 42 closes. This is not what you want to see if you're a bull. We've got less than a minute left in for the close of 42, and you have more traders taking profits. Why? Because of what I just mentioned. Even though it looks strong, it's still a possible expanding triangle. So we may get a 50% pullback of the rally from the 40 low. I was looking at this yesterday. ARKK, I was talking to someone about it, but obviously Kathy Woodstock, and she bought, a lot of the COVID stocks, Zoom, Peloton, a lot of those have this similar pattern, parabolic wedge, bull flag, and then bear breakout. And now, obviously, tight trading range. 3 consecutive bull bars, probably buyers below in a second leg, but we may have to get a pullback first. I am flat, and I mentioned I bought during 39, and I just got out, and I'm a little bit tired. And typically, if I ever get tired, I wait for however long it takes to get more energy. So if I feel mentally tired, I all of a sudden I'm a lot less willing to take trades, even if I think buyer's below 42, because I don't want to make a mistake. And therefore, I'm going to wait for a few and maybe look to take a trade in 20 or 30 minutes. Plus, I like trading the morning, and I'm happy with what I've done today. And therefore, naturally, I can feel, let me say it differently. I like what I've done today from a performance standpoint. And right now, I feel like my performance is starting to fade. And I really shouldn't have gotten out during 41. My premise was the market was going to go above 38. So I should have held on to the trade. And I can feel, and whenever you feel that your performance is slightly starting to lower, that is a perfectly acceptable reason to either stop trading or just take a break. Stopping trading just because you're up and you have a profit for the day, that's good and all, but I really don't agree with that. I agree from the standpoint of performance, because if you think about your trading should be like a business or a machine, kind of like a factory. And your job as a trader is to produce a lot of trades over a period of time. And you should know the expectation behind those trades. And whenever you feel that you're not producing the quality that you're expecting you should produce, that is a reason to pause your trading. But just because, I bought the close of 7 and I made a profit on 9, that is not a reason to just stop trading for the rest of the day because you're fearful of losing the profit. The markets are mathematically based. They have nothing to do with fear and emotions. Everybody wants to talk about it, fear and emotions. And I'm sure, you could argue, I'm sure there's plenty of hit traders or in the investment bankers that, who knows? Tom Hugard is an example of one of them. He's a good trader, and he deals much more with emotions when he trades. He was talking about that with retail trading and whatnot, with retail traders. And back in the day, I don't remember the story exactly, but back in the day, he would they would measure what their retail clients were doing, and they would do the opposite. Something like that. I'm sure I'm butchering it a little bit. But the point is, everything we're looking at right here is mathematically based. And right now, the reason I'm not willing to buy, other than the fact that I said it's a little tired, 42 is three consecutive bull bars at the moving average, and the stop is below bar 40. And I'm not sure at the moment if there's a 60% chance the market is going to go here before it goes here, before it pulls back. And because of that, I'd really rather look to buy a pullback if I'm going to buy all the way up here. I don't think the risk reward, I don't think the probability of the trade justifies the bad risk reward. And therefore, I'm hesitant to buy here. Look at the 15-minute chart. 5 consecutive bear bars and an outside up bar on the prior bar. That reduces the probability for the bulls. So we may get a deep pullback and then a second leg. I'll be back in just a few minutes. Tight bull channel, good for the bulls. Series of bull bars. Lack of bear bars. Breaking out above the pass from 33 to 46. What about buying right here? Well, you can argue it's the second leg up. Rally to 42, pull back, second leg. And I suspect there might be more sellers up here. The issue with buying, risk reward. If you're long and you put a stop below bar 40, what's the probability the market goes here to 56.50 before it goes down here? And at the moment, I think we may pull back. So I'm more interested, if I was buying, I'd use a tighter stop and get out below a bear bar or get out below a bar like 45. At the moment, I'd rather buy a pullback. Too much risk that I think we will pull back. Whenever you get an inside bar, which is the same thing as this tight trading range right here, but we have an inside bar on the 15-minute chart, it's common for the market to retest the inside bar. So I'm a little bit hesitant to buy here. We broke below the channel with bar 39 and 40, the red line. And therefore, it's common when you break below the channel to retest the top of the channel. So we may have to go somewhere up here. We can do it one of two ways. We can go sideways for a lot of bars and get there, or we can go straight up. But with the tails and the lack of conviction by the bulls, I'd rather see more buying pressure. This is the euro versus the dollar. And you can see this is a monthly chart. We've rallied, we've been in a tight trading range for a lot of bars, and we're getting a second leg. So this is interesting. You can see, let me just go to a daily chart, consecutive buy climaxes, and that increased the risk that we may have to pull back for a couple of legs. But overall, this is a fairly strong enough, this is a strong surprise. And next month has the potential to be another strong bull bar. So we may end up getting a leg one, pull back, leg two, but we'll see. The dollar has obviously been doing bad in most markets. Dollar Canadian selling off, and we're getting a fairly big bar here. What about buying the close of this bar? It is a sell climax, and we may pull back for a couple of legs, but in general, that's a pretty big bar, and with a lot of selling pressure. And I'd be a little bit hesitant to want to sell that bar. Weekly chart, tight trading. We've been in a trading range since October of 22, and we're getting a downside breakout of the range, and that increases the chances this strong enough breakout will probably get a second leg, middle of the trading range. So we may have to go sideways for several weeks, but probably a second leg down, likely. Let me see, I don't know if I have data on this. I do not. I was going to look at crude oil, but I don't have data. Someone asked about Bitcoin. Bitcoin, consecutive buy climaxes, failed breakout below the wedge, and we're starting to reverse up. What about buying right here? Yeah, you can, but my overall concern is this. what is this? This is obviously a channel and pretty much a trading range. And we have a tight trading range right here. So if you're a bull, do you want to buy right here? You can buy. I mean, I think the odds are we're going to go above this high, so we probably will go to 80. But the challenge here is, where's your stop? If you're buying, which I think is probably okay, you need a wide stop. So point is, buying this, we could easily fall to a new low. Bulls continued to get more buying pressure. A lot of traders, as I mentioned, when they see a tight channel, they'll use a tight stop, maybe a measured move below an average bar range, below every bar, taking a chance that the market is going to drift sideways to up. So here, if I do anything, I'd use a tight stop, such as below 45, like I mentioned on 46. At the moment, I'm flat and more or less trapped out, middle of the range. I'm not really thrilled about buying right here. 2 legs up, rally 42, pause, second leg up 47, getting near the middle of the day's range. It's always in long, so you can be long, but middle of the range in a trading range day, I'd rather just wait. In a trading range, I'm resistant to entering or trading in the middle. And that is my issue right here. Always in long, you can buy for any reason, but near the top of the range, so we may have to pull back, but lots of bull bars. So it is buy the close, expecting higher prices. I do want to buy, but for me, it's an issue of risk, reward, and probability. The buy was down here and arguably below 44. Even though it's an inside bar, 43, it's sensible. My issue here is the stop is far below 45 and the bodies are getting smaller. And I don't know if the probability is 60% that we're going to go here before we pull back. And then obviously putting a stop down here at below 40, that is just too much risk. I don't think we're going to go up here before we pull back. So at the moment, I'd rather look to buy a pullback. Big down, big up, probably big confusion. We could get a buy vacuum test of the line, the top of the channel. We spent a lot of time. I think this tight trading range, bars 1 to 6, is important. We spent a lot of time going sideways in that range. And that makes me think that the open of the day is going to be an important magnet. Obviously, it's been an important magnet. $60-minute chart. Let me just talk about the 45-minute. I was talking about that earlier. 45-minute chart. This is basically what I was talking about. You remember this bar? This bar ended up closing on its low, and I mentioned that we could get a reversal up, and that's what's happening right here. Big bar, but so what's the probability that the market goes all the way up here before it goes down here? I do think that we're going to get a second leg up, but as far as buying, putting a stop down here, I don't think there's a rush. I think more likely we're going to have to stabilize. In other words, this bar closes at 13:15, so which means this bar opened 6 minutes ago. So we have 39 minutes until this bar closes. And my belief is we have a really big buy signal bar outside up on the prior bar. So what do I think the next 39 minutes is going to look like? Something like this. So if I had to guess, I do not think this bar is going to get closed somewhere up here. I think more likely this bar is going to close around the open of this bar or below. And that makes me think that we're probably going to be mostly sideways. Really what I'm saying is I think we're going to get a disappointment bar right here. So that is why I'm really not all that eager to buy here. I think I can buy at a lower price or the same price over the next 45 minutes. small pullback trend, so really no reason for traders to be selling here. I'd rather wait and see more sideways trading before I'm looking to sell. And then if I'm long, it doesn't matter if I'm buying right here, close at 50, bar 50, or if I've been long since 40. The stop is in the same place. At the moment, when I say stops in the same place, what I mean is I think traders will get out below a bear bar or 2 or 3 consecutive bear bars. There might be buyers below the first bear bar, but the reality is you can get out below a bear bar and then wait to re-enter, or simply get out below 2 bear bars, or get out if the average bar range is, let's say, 4 points, get out 3 or 4 points below any bar. And the reason is most traders aren't going to put a stop all the way down here. Therefore, they'll use a tighter stop. Russell's on mute. 52, good bar for the bears, but a trading range is more likely than the start of a strong sell-off. We've been in a small pullback rally since bar 40, and because of that, that increases the risk that those traders buying below 52. What about buying above the 53 high? Oh, it's a high one buy fairly late in a channel, and that lowers the probability for the bulls. Strong enough breakout, while there might be sellers above 53, I suspect it's going to go mostly sideways. The rally to the 51 high is fairly tight, and I suspect we're probably going to have to enter a trading range for several bars before the bears can get a strong downside breakout. The bears, they want a lower high with 27 and a test down to the 40 low. But that's a lot of bull bars. Look at a 15-minute chart. That's a fair amount of consecutive bull bars. 4 consecutive bull bars increases the odds of buyers below in a second leg up. So we're probably going to have to test the 51 close relatively soon. My problem here with the bears, 54, is 54 is a possible second leg down. It's easier to see on a 2-minute chart. Way to sell off, bull bar, so is the pause, and then a second leg down. Bear bar 52, pause 53, second leg down 54. I'm going to remove the measured move down of the opening range. So we have a tight bull channel, trend line break 54, probably going to have to retest the highs. And we still may have to test the top of the channel, the red line. So the market may have a hard time getting far away from it. Typically, when you break below a channel, when you get a failed breakout below the channel, such as 39 or 40, the bear channel, you often test the top of the channel. So the odds are we're going to test the red line. High one buy. High one buy, 55. But I suspect there might be sellers above, but realistically, we're probably going to go above the 51 high. Tight trading range, but we have that magnet of the red line, the top of the bear trend line, just above. Even though the symmetry is bad, the reality is it's a bear channel, and I suspect we're going to go above it. We don't have to stop there, but overall, I suspect the market is going to go mostly sideways. We've had a lot of expanding triangles intraday, especially on the open this week. And part of that reason is the higher time frames. So we have an expanding triangle here on the 60-minute, 240-minute. It's that same expanding triangle. Whenever you have expanding triangles on the higher time frames, you often get more and more of them on the lower time frames. Patterns are nested. Is this a good buy for the bulls? 12:30 prior hour? You can argue it is. One of my problems with the bar is it's forcing traders to buy in the middle of an overall tight trading range. And that really is not all that ideal for the bulls. I am long I bought below 52, taking a chance we would get above the 51 high. But I have to say, from a time standpoint, I'm fairly disappointed on this trade. I still think we're going to go above the 51 high, but for me, it's getting more and more difficult to justify the risk reward. I ended up moving my target to 39 even, which is 3 ticks below the close of 51. Why 3 ticks below? Because I'm fairly disappointed on the trade. And in part, it's a time issue. I've been in this trade for several bars. My expectation is we'll probably get within at least 1 tick of the 51 close, and it's more than twice my risk, actual risk on the trade. And therefore, it's a sound trader's equation. Okay, I just got filled. And you can see we touched the high close. I thought about having a target above 51, but I have to say, whenever it becomes more difficult for me to justify the math, I become less willing to stay in the trade. And in that case, my stop was below 54, and I really don't want to be buying up here. It's already 2 legs up, 55, pause 56, second leg 57. Therefore, I just decided to get out of the trade, even though I think we're going to the red line. As far as selling, we got a lot of bars above the moving average, and we have an obvious magnet just above. So I think we're slightly more bullish than bearish. However, I would rather look to enter on a pullback if I can. I think we're slightly more bullish than bearish. However, I would rather look to enter on a pullback if I can. Maybe buying below 54. You can see not a lot of traders eager to buy up here. So I'm not alone in taking profits near the close of 51. You look at the 15-minute chart, that's a fairly strong 4 consecutive bull bars. So the odds are we're probably going to go higher. But a bull bar after a bear bar, 15-minute chart, we may get a pullback and before we get a second leg. So that's my hesitation here with buying. A doji 58, does that look like the start of a strong bull trend? Or does 58 look more like the evolution into a trading range ever since bar 52? To me, it looks like we're evolving into a trading range. And because of that, I really don't want to buy in the middle of a tight trading range fairly late in the rally. So I'd rather look to buy a pullback closer to the moving average. Whenever I'm confused about the market, I immediately look for stop orders. And the reason for that is limit orders are great for when you have certainty, or better yet, let me say it a different way. Limit orders are great when you have an understanding of what's likely to fail. There's a breakout that's likely to fail. But in a situation like this, I think the reality is you can buy below bars and scale in, but overall, I'd rather wait and see what the test of 54 looks like. The bulls, they've had a rally for a lot of bars, but we're starting to form a tight trading range. And the risk is that we get some kind of break below the neckline, measure and move down to the open of the day. That is part of my concern. Today's Friday, so the weekly chart is important. And right now, we have a doji, 5,600. Let me change the color. We're 34 points above 5,600, so obviously that's a little bit far. You can see we're getting near the bottom of the tight trading range, the bar 54 low. Probably buyers below, but overall, I think we're going to be mostly sideways. So I think it's more bullish than bearish. So if I had to do anything, I'd be buying and scaling in lower. But right now, I'm flat in the middle of a tight trading range, and we could get a fairly deep pullback. We could test all the way down to the green line at the open of the day. So what about the always-in traders? Well, always-in bulls, they buy above 40, and some might get out below 52. I don't think they have to. And then others maybe get out a couple of points below 58. But realistically, tight bull channel, so probably buyers below scaling in lower. So I don't think there's a clear always-in short setup yet. And that means we're probably going to continue to go sideways to up. You can see just like that. Obviously, quite a few traders buying. So what happened there? It's easier to explain. It's easier to see it on the 15-minute chart. We have a high one buy here, and the market sold off. Let me do this. I'm going to turn the screen off for a moment. I'll download the pointer in just a minute, but we had a high one buy. The expectation is a pullback and an attempt at trend resumption. And that's in part why what happened on 59. The market pulled back, found buyers, and attempt to resume. But what about buying above 59? It's really not ideal, forcing you to buy high in the top of a tight trading range. Okay, I'm going to turn the screen off and download a red pointer. Okay, I'm going to turn the screen off and download a red pointer. So that it's easier to see the mouse. Okay, that should be at least a little easier to see the screen where my mouse is. So far, 60-minute chart, the current hour closes this bar in a little less than 2 minutes. And you can see the entry bar below the reversal bar at 12:30 is fairly disappointing. It's a bull bar, but it's a small bull bar. And that's a reminder that we're in the middle of a trading range. So really not all that great. Bear bar 61, the middle of a tight trading range, really not all that ideal of an area to be selling. You're selling in the middle of what is a tight trading range with all the bars above the moving average. That slightly increases the probability for the bulls. I am flat. My last trade was buying below 52 and getting out during 57. And I really don't want to buy. I'm really hesitant to trade in the middle of the tight trading range. We're more bullish than bearish, but we're in the middle of the overall trading range day. So I'm really less interested in trading here. Plus, the day's getting late, and I'd rather wait for something more clear, a stronger breakout. Always in bulls, I think it's okay to get out below 61. Too much risk that we test down to the 54 low and maybe even the open of the day. We're so close to the red line that I suspect we're probably going to get there. For the bears, it's a wedge, 51, one of these highs, and then 63. You can also call it a failed breakout of a tight trading range, possible final flag. But I suspect probably at least a small second leg up and test of the red line. As far as buying here, I'm not going to buy. We're so close to the red line that I'm not interested. The risk reward is not that great. So I'm flat, waiting for more information. Obviously, no one wants this price action. My preference would be getting some kind of strong breakout up or down. Something like this, big bars for a small second leg. Realistically, we're probably going to be sideways for a while. The range is contracting. Lower highs, and in this case, higher lows. So we have a range expansion and then range contraction, but overall, probably going to be sideways. That is probably close enough of a test of the red line. Still may have to go a little bit higher, but we're basically there. It hadn't quite touched it, but I suspect it probably will. Always in bulls or long, probably stop below 62, maybe 63. And I suspect some of them will get out below a bear bar. But for me, I'm flat. Trading range, we're in the upper portion of the range after several attempts up. I suspect this whole thing is going to convert into a trading range, so I'm not interested in being long. Decent bear breakout, but look where you are. You really want to sell in the bottom third of the trading range with 54? Not really. The sell was selling the close of 55, the bad high one. 65, the prior bar, the bad high one. And a lot of traders scalped out below 62. 66 is enough of a surprise that we may get an attempt at a second leg. But I have to say, if I'm going to be selling, especially in the final hour of the day, I'd really rather sell a strong, consecutive, strong bear bars, and certainly below the moving average. So I'm not really all that interested in selling this. What about buying it? Well, it's a decent bear breakout below 65. 66 is. And 66 is not a great stop entry buy above. Therefore, if you're buying it, what are you betting on? A test of the 66 high? And therefore, buying during this bar, 1 times your risk. In other words, if you buy at the market right now and you set a target at the high of 66, 1 times your risk would be putting a stop right here at 32.65. And there's at least a 50-50 chance that you get stopped out. So the point is, the risk reward's bad. Better to be buying down here, but you're buying a decent breakout and you may get a second leg. We're high in the overall range. We've been rallying for a little while. So I wouldn't be surprised if we get some kind of sell vacuum. But overall, I need to see a stronger bear breakout than this. And as far as buying, you will have traders buying the low of the prior bar. Their premise is if they buy the low of the prior bar, they set a limit order at 34 even, and you can see the market went 1 tick below it. Their premise is they can make a profit, exit somewhere in the midpoint of the 66 before they get a measure move down of the bar. And what do you do if 67 closes on its low? A default method that you could use would be just exit at the low of if this bar closes on its low, especially below 66, just get out. For me, I'm more interested in waiting to see what the breakout looks like. I think we may end up testing the open of the day. I want to sell, but I'm really not interested in selling after 66, 67. 4-bar bear micro channel, probably sellers above. The bottom of the trading range, 54 low. Range is expanding, and this could be the bottom of the range. So really not ideal. For the bears, if they're short and 68 is a bull bar closing on its high, I think it's worth exiting your shorts. Because of the 4-bar micro channel, I suspect we're going to go a little bit lower. I would have rather have seen a stronger looking bear breakout. One of the most important things when you're trading is to learn to understand when the market's neutral and the probabilities are not all that high, such as right here. So for me, I'm always thinking of risk reward probability. So if I'm short, stop above 64 right here, I'm always asking myself, what's the probability that the market is going to go here before it goes here? And if I look at it and I think, yeah, it's probably not 60%, it's probably more 50-50, then I'm not going to take a trade where I think the risk reward is 1, where I'm only going to get 1 times my risk. And that is the hesitation here. I don't think the risk justifies the probability. And that happens a lot with trading ranges. That's why traders are selling above bars. They're selling dojis, betting on reversals. And then they're buying back their shorts down here because they know there's bulls buying, understanding that the risk reward is bad for the bears. So looks like we're going to be sideways. This right here is the issue for traders. You can see more traders buying below 66 because of the bad risk reward. For the bulls, is always in long above 68. It is. It's a credible stop entry, but it's forcing traders to buy in the middle of the tight trading range. And that is really not ideal. So buying here, stop below 65, 67, you're betting on a breakout, and this is the issue, risk reward. You can take the buy. We're more bullish, we're slightly more bullish than bearish. Most of the bars above the moving average since 47. So that makes me think we're probably going to go higher. But buying right here, probability is not as high as it could be. Why do we know that? For a few reasons. One, we would not be in a tight trading range if the bulls had exceptionally high probability. This is also possible, just part of the test of the red line. We almost reached it here. Okay, we just touched it. So that's good for the bulls. Do we have to stop the red line? Of course not. Symmetry is not all that great, but you will have computers paying attention to it. I think more important is the tight trading range right here. Bulls, they want a double bottom and a break above the neckline and to measure move up. I'm going to remove this for now. Obviously, bulls getting strong breakout. But let's see how this bar closes. The bigger the bar, the better for the bulls. The more it closes on its high, the less this bar pulls back intra-bar. All of those are strong, would be signs of strong buying pressure. Look at this bar. Do you see how it's pulling back quite a bit? Is that a strong trend? Or do you look at 69 and you think, is 69 the start of a strong second leg up? Or do you look at 69 and say, I don't know. The market is not immediately trapping traders who are short. The bears who sell above 64, it looks like they're being given the opportunity to make money. So the concern here is expanding triangle. We've had a lot of expanding triangles recently. What about selling below 69? Even if it's a bear bar closing on its low, you will have some traders selling it, taking a chance that we break to the downside and test the open of the day. But it'd be forcing you to sell right at the moving average. And that is really not all that ideal. So I suspect we're probably going to get at least a small second leg up. This looks like a surprise, 68 and 69. Therefore, we'll probably get a second leg up. Obviously, traders are buying. And that is good for the bulls. Enough of a surprise, 68, 69, that I suspect we'll probably get a second leg up. The bigger the tail, the lower the probability for the bulls, and the added risk that we end up going more sideways than straight up. A little bit of a tail on the close of 67, 69. that increases the risk that we get a deep pullback. That increases the risk of a pullback. So it's a little bit lower probability for the bulls. It's still a surprise, 68, 69, and therefore we'll probably get a second leg up. But for the bulls, that is not, the bar could be strong, could have been stronger. It's also climactic, and that increases the risk that it's a failed breakout. Every minute that gets added to this bar, every minute that goes by where the market's not racing to the upside increases the probability that we end up going more sideways. So you have some bulls who bought the high of 69 during the bar, and they scaled in lower, and they're deciding what to do. Are they so disappointed on the trade that they're going to exit at the high of the prior bar? Or are they going to buy? Or are they going to hold, betting on a breakout above the high of the prior bar? That is what the market is deciding right here. Full breakout bar and an inside bar on bar 70. Strong enough breakout will probably get a small second leg up. High one buy on 70, so the expectation is a pullback and then an attempt at trend resumption. If we get a bear bar closing on its low, you will have some traders exiting. But 4-bar bull micro channel, probably buyers below. 4-bar bull micro channel, probably buyers below. The bulls got the minimum. They got a second leg up above 69. But tough to sell after 3 consecutive bull bars closing on their midpoints in a 4-bar bull micro channel. I just took part off. I bought at 68, got bigger. 68 rallied, pulled back. It rallied up to here, stalled, and then it got bigger within the final minute. And so I ended up buying at the market, and then I bought a little bit of a pullback after this bar closed. I took part off, and I'm debating what to do on the second piece. 68, 69, strong enough for a second leg, but the odds are the upside is probably limited. But as far as buying right here, as far as selling, I'm certainly hesitant to sell. Too many bars up in the rally. But we're high in the trading range, and that makes me think we're probably going to go mostly sideways. I ended up just closing the position. We're stalling too much, and we have a tail, 69, tail inside bar 70. I think we might end up going more sideways. Plus, it's late in the day on a Friday, and I'm a little bit hesitant. Typically around 2:30, I'm a little bit hesitant I become less willing to place trades. Obviously, a mistake to exit, but late in the day, that's fine by me. It's still always in long, and for the bulls, probably have a stop below the prior bar. That's what I would do at this point. I'm not going to put a stop below 67 because that is too much risk relative to the reward potential. What are the chances we get up to the blue line? We might. And what do you do if you're flat? Well, the choice is pretty simple. If you're flat and you get a bull bar, if this bar closes as a bull bar, you can buy at the market, put a stop, maybe a point or two below the prior bar. So you buy the close 72, stop a couple points below 72. You can buy a pullback. It doesn't matter if you bought above 68 or you buy the close 72, it's the same trade. Because of the inside bar, 70, we may pull back. 72 becoming a little bit climactic, bigger bar than 71, increase the odds that we may pull back. You can see we have a tail on 72. a warning that we may pull back for a bar or two. We may end up testing the high of 70. You can see we're testing back to the inside bar. No surprise. Whenever you get an inside bar, especially late in a rally, it's pretty common for the market to retest the bar. What about selling below 73? You can exit longs below the bar, but outside bar, probably buyers below. Consecutive buy climaxes. High in a trading range. We rallied 42, rallied 51, sideways, rallied again 72, but a micro channel since 67. That increases the risk that there's probably buyers below. That's a problem for the bulls. Several attempts up, and it's possible the rally is exhaustion. Consecutive bear bars, 73, 74. We'll probably get a second leg down. And that increases the risk that we end up testing. If this is a wedge, 1, 2, failed breakout, that increases the risk that we could test all the way down to the 67 low. Bulls, they obviously want 75 to be a bull bar and to get a second leg up above 72. To be clear, I would not be long at this point. Too much risk that we get a second leg down. So the risk for the bears is a test of the 67 low. The bulls, they had a breakout 69, second leg up 72. And this is consecutive buy climaxes. We rallied here, 42, paused, rallied again 51, sideways, rallied again 72. So the risk is real that we get back into this trading range. The bears should not have allowed a consecutive bear. The bulls should not have allowed 73 and 4 to form, especially consecutive bear bars. That increases the odds that whatever reversal up we get will be minor. Open of the day is a magnet. We're running out of time, but I think we're going to try and test down to the 67 low and the open of the day. You can see bears trying to get down to the most recent bull leg, the low, 67. And it looks like they're probably going to get there. Too late in the day to do anything, but not really a great buy above 76. It's a part of a micro channel since 73. And with three consecutive bear bars, 73, 74, 75, there's probably more sellers above 76. And we may go sideways. You buy the closed bull 72, disappointed by the three consecutive bear bars, and they're trying to get out break even. I'll start the review in about 10 minutes, and then I'll take a look at questions after the review. So good movement overall today. Let me pull up Discord. Daily chart. Tight bull channel, getting near the highs, but a lot of buying pressure. And that reduces the probability that whatever sell-off we get will lead to a successful bear breakout. When I say that, what I really mean is the odds are there's buyers below. Tight bull channel is probably going to get a second leg. The pullback can be deep, but realistically, any pullback we get will probably have buyers. Big down, big up, big confusion, and therefore we may go sideways for a lot of bars here. And that would increase the probability of getting a deep pullback. Weekly chart, we have a bull bar closing on its high, and that's good for the bulls. Smaller bar relative to last week. This rally, though, is strong enough that I suspect there's buyers on the first reversal down. And what are the chances we get above the all-time high? We probably will. But even if we do, I suspect sellers above. What's the chances that we get a measured move of this range? I think that is probably unlikely. So the odds of us getting a strong reversal from the low to the high, all the way up here to 6,000, I don't think that is probably going to happen. It might, but realistically, I suspect. And let me say something else. For the market, this is a strong enough rally that the bears need to do more. So it's always in long, and you can buy, and bulls are long. If we get a bear bar, there's probably buyers below it, and we'll probably get a small second leg up. But if we get a series of bear bars, of sideways bars, or if we get a series of sideways bars, that will increase the probability that this leads to a failed breakout, and then we test the breakout points down here. But at the moment, probably a small second leg up. Risk is big for the bulls. So if you're a bull and you're long, 1 times your risk is 6,200. Then you have to ask yourself, realistically, what's the probability that we get down to 6,200? And at the moment, I don't think that is likely that we get up here. So I think we're probably going to pull back before we go up to 6,200. And what that means, what I mean by that is profit taking is likely somewhere up here, because the bulls are not going to be interested in using that wide of a stop. We have decent bear bars here, decent bear bars here. That increases the odds that this whole thing is transitioning into a trading range. First bar of the day, we have a bear bar after a gap up, but always in long, probably based on the gap. And therefore, my expectation is we're probably going to get a second leg up. But not a great stop entry buy for the bulls. So there might be sellers above 1, but I suspect there's buyers below. And in bar 2, we have a bull bar. For the bulls, it's a high 1 buy. You can argue that bull breakout, the gap's a bull breakout, and therefore we'll get a second leg. But inside bar 2, increase the odds that there might be more sellers above 2. 3, reversal down. The bulls triggered the buy above 3, and then above 2, and a reverse down on 3. Tight trading range, probably buyers below, probably sellers above. 4, bull bar. And then 5, we have a doji. We triggered the sells below these bars, and then we rallied to the upside. So the information that we have here is that this is a tight trading range. And tight trading ranges increase the risk that we'll have a lot of trading range price action today. We're also inside of yesterday's range, close to the midpoint of yesterday's range. The middle is somewhere around 35 even from the high to the low, and that increases the chances that we're going to have a lot of trading range price action. Bar 6, bull bar closing on its high above 5, good for the bulls. Probably going to go at least a little bit higher. And then 7, we had a strong bull breakout bar. What about buying the close of 7? You can, but it's a climactic bar. And climactic bars increase the probability that the market is going to have to go sideways for several bars before you get some kind of second leg. Inside bar 8, good for the bulls, but a deep pullback of 7 inside of an overall trading range day. And therefore, you may have more profit taking up here than traders aggressively buying closes. 9, bull bar, but closing under the midpoint. Increases the probability that there's sellers above. Even though we're in a micro channel from 5 to 9, and there's probably buyers below 9, you're high in an overall trading range. And you have a lot of overlap. So the bulls buying below 9, scaling in lower, that is a little bit tricky of a trade. 10, big bar for the bears, but tail below 10. We'll probably get a second leg down after 10, but the second leg may not come until somewhere up here. We have a rally, bar 5 to 9, a bull micro channel, so probably buyers below 9, scaling in lower. And then you can see 11, it's a bull bar closing on its high, but it's an inside bar. Inside bar, it's a big bar, forcing traders to buy just under yesterday's high, which is really not all that ideal. 12, doji, probably buyers below in at least a small second leg, but if you're a bull and you bought above 11, is 12 the follow through you wanted to see? Probably not. And that increases the odds that there's going to be more traders buying. There's going to be more traders selling up here than buying. 13, bear bar closing on its low. What about for the always in bulls? They probably get out below 13, and the bears, they can sell below 13, stop above 12, betting on a wedge. 1, bar 7, 2, bar 9, and then a truncated wedge, bar 12. Okay, swing short below 13. And bulls, I would certainly get out of longs. And then 14, we have follow through. Good for the bears, but bottom of a tight trading range. Probably going to get a second leg down after 12, 13, and 14. So probably sellers above. 15, bull bar. For the bulls, it's a double bottom with 10. Bull bar closing on its high, but I suspect sellers above and a second leg down. And then 16, we have a relatively strong bear bar. Good for the bears, but what do you notice about 16? 16 is a very big climactic bar, and it's a second leg from the sell-off that began at 12. Sold off to the 15 low, pulled back, second leg down, 16. It's also breaking out below 1. So while the market is always in short 16, the odds are it's probably going to pull back. And then 17, we have a bull bar closing on its high. For the bears, I think always in bulls probably get out above 17. Even though 16 is a strong enough breakout that will probably get a second leg down, the risk is big for the bulls. And if the risk is big for the bears, they have their stop above 16 or above 12. In either one of those examples, the probability is not 60% that we're going to go lower. So you have a stop above 16, and we're now at bar 17. There's not a 60% chance that you'll make 1 times your risk before you get stopped out. It's much closer to 50-50. And because of that, you'll have a lot of traders exiting, betting on the opposite. 18 consecutive bull bars, good for the bulls, probably going to get a second leg up. Pause, 19, so a trend line break, and then 20 was that second leg. Rallied, pulled back second leg, but it's a 4-bar bull micro channel. So the rally up to the 20 high might be the first leg, and that's what happened with 21. We broke the trend line of the first leg, testing the signal bar high, bar 17, and near the close of 16, and we reversed up on 21. Whenever you get situations like this, there's actually 21. The sell-off to 21 was actually a high probability buy. You have the open of the day and a buy signal bar on bar 17, just above the open of the day. And if you look at that and you think to yourself, if you think about the logic, you'll have bears selling the high of 17, betting that we're in a trading range. You'll have bears selling the high of 17, betting that we'll get a second leg down, and they get trapped with bar 18. And a lot of those bears selling the high of 17 and more higher, they're going to be disappointed on the trade, which means you'll have limit order traders buying back shorts at the 17 high. And you can see 16 tested near it, and then it bounced on 17. Some of those bears, they sell the high, they sell more higher. And they immediately set a limit order to get out break even on the entire trade. Other bears, they sell the high of 17 and more higher, and they use 21 to exit at their first entry, or even a small profit on their first entry. 21 outside up, good for the bulls, but bad risk reward, big bar, and therefore bad risk reward buying above 21. Context is okay for always in bulls to buy, but not ideal. And then 22, we have a follow through bar, but a tail above 22. That increases the risk that there might be more traders selling above 22 rather than buying. And you can see 23, bear bar, but a bad high one buy above, probably sellers above, and a small second leg down. 24, a doji. For the bulls, a lot of bulls may start exiting here. Too much risk that it's 2 legs up in a trading range day. And the stop is relatively far away for the bulls, the 21 low. And because of that, the probability, the stop's far for the bulls and the risk reward isn't great. And that lowers the probability since the market is in a trading range. 25, an inside bar, but I suspect sellers above and at least a small second leg down. And then 26, we have a bull bar, but a possible wedge. 18, 22, and 26. And then 27 outside down. Good for the bulls, probably going at least a little bit lower. We had a surprise on 16, and that increases the risk that we test down to the 16 close. 28, a bear bar, but not a good stop entry. 28, a bear bar, closing above the midpoint, but not a good stop entry for the bears. Odds are we're probably going to go lower. And then 29, and then another bear bar closing on its low. Now we have 3 consecutive bear bars. Good for the bears, probably going at least a little bit lower and going to get down to the 16 close. And I suspect we'll probably fall to a new low of the day. And 36, 4 consecutive bear bars, still sell the close, but getting low in the range. 37, you can sell it, but you're getting near support. The 16 close, you're getting near the moving average. 60-minute moving average, the dashed line, and you're also getting near the low of 17. And then you can see 8, 32, it's a bull bar, but probably sellers above and a small second leg down. 33, a bear bar, it's an inside bar, but probably buyers below. 34, we had a low 1, there were buyers below the low 1, and the market reversed up. But micro channel since 27 lowers the probability of bulls buying above it. You'll have some bulls buying the close or buying above the 34 high, but they're buying more. If anything, they're buying probably more below the 34 high. And you can see the bulls failed to trigger the buy, so a sign of weakness. Bear bar 35, but buyers below it, 136. 36, possible wedge, 32, 34, 36. I think it's reasonable for bears to start exiting above 36 because you'll have bulls buying. We have a stop entry on 34. We have 2 stop entries, 32, 34, and the market hasn't fallen far below it, so there's added risk that this is some kind of wedge. 37, bull bar, good for the bulls, probably going at least a little bit higher. 38, a bear bar, a doji. For the bears, it's a double top with 33. Next, they want a strong downside breakout and a measured move based on double top with 33. Next, they want a strong downside breakout and a measured move based on they want a measured move based on the tight trading range. Give me just a second. I had to stand up and move around for a minute. So we have a bear bar 38, but tight bear channel, first break of the micro channel that ended on 36. Therefore, added risk we get a second leg down. But even if we do, I suspect there's probably buyers below. And then you can see 39, strong surprise, bear breakout, good for the bears, probably going at least a little bit lower. But what do you notice? 32, 36, 39, it's an expanding triangle. And that increases the risk that there might be more traders buying down here rather than selling. 40, bull bar, possible midday reversal, therefore reasonable for always in bears to exit above 40 and bulls buy. 41, bull bar, breaking out to the upside, strong enough bar, probably going to get a second leg up and test the 38 high. 42, 3 consecutive bull bars, probably buyers below and at least a small second leg up, but near the moving average. So some traders would rather wait for a break of the moving average. 43, 34, 42, 43, 44 at the moving average, probably going to go sideways. 45, we broke the micro channel that began on 40, so a 5-bar bull micro channel, probably buyers below and a second leg up. 46, bull bar, breaking out above 42. And then 47, now we have another bull bar. So we're getting a series of bull bars. The bulls, they're owning the market in terms of time and price. and that's a sign that the bulls are gaining control. Increase the probability we're going to go higher. 48, another bull bar closing on its high, but middle of the trading range, really not ideal. And then 49, another bull bar, but body's getting smaller. 50, outside up, so another bull bar, good for the bulls, but we're getting a lot of overlap, which increases the odds that we may pull back soon. 51, an even bigger bull bar, so a bigger buy climax than 50. Late in a rally, micro channel, almost a micro channel with the exception of 44 and 49. Therefore, probably buyers below. 52, bear breakout, but probably buyers below, scaling in lower. 53, a doji, bad high one, so probably sellers above and a small second leg down with 52. 54, bear bar, but 2 legs down, 52, pause 53, 54, a bear bar, and a tight bull channel, tight bull rally, probably buyers below, and we'll probably test above the 51 high. 55, a bull bar, good for the bulls, but a bad high. It's a high one. That increased the odds that we may go sideways. And then we got a doji, 56. I thought buyers below and at least a small second leg up and a test of the 51 high. And then 57, bull bar, but then doji, 58. And that was a wedge. The market rallied, paused, rallied, paused, rallied again, and paused on 58. And that's why 59 sold off. 59, test to the bottom of 54, the tight trading range, and reversed up, but big down, big up on the 59. So a bad stop entry, forcing traders to buy high in an overall trading range. 60, we triggered the buy above 59, burst down, but probably buyers below. 61, consecutive bear bars, 60, 61. But selling below 61, right in the middle of the tight trading range at the moving average, really is not all that ideal. 62, outside up, good for the bulls, but tight trading range. Because the market's holding above the moving average, there's added risk that we get a second leg up after 51. So it's possible where tight trading range above the moving average increases the odds. The odds slightly favor the bulls getting trend resumption. 63, not great for the bulls, possible failed breakout of the tight trading range and final flag, but tight bull channel. So better to look to buy or buy pullbacks. We're getting near the trend line here, but we don't have to stop there. And that was the red line I had drawn for a while. 64, 3 consecutive bull bars, probably buyers below. 65, a doji, but a bad high one late in a rally. Several ways to draw it. Rallied one, second leg, third leg, you could say first leg, pause, second leg. Doji, bad high one, top of the tight trading range, probably sellers above. And that's why 66 broke to the downside. 67, consecutive bear bars, tail 66, tail 67, probably buyers below, and we're probably going to continue to go sideways. 68, a bull bar, and then we broke to the upside with 69. 69 was enough of a surprise that I thought we'd probably get a second leg up. And then 70, it was an inside bar, good for the bulls, but whenever you get an inside bar, especially late in a rally, there's added risk that you pull back to the inside bar, which is basically a magnet. It's a triangle on a higher time frame, on a smaller time frame. And that is a tight trading range on a smaller time frame as well. Bull bar 71, breaking out above the inside bar. And another bull bar 72. We have a tail 71, tail 72. So a little bit of a wedge, possible bull breakout of this small channel on a smaller time frame. At a measured move target, low of 67, high of 64. Increase the risk that there might be more sellers around the 62 high rather than buyers. And then we got a bear bar 63, good for the bears, but probably buyers below. Because of the micro channel, 67 to the 72 low. Because of the micro channel, we probably will get a second leg up even if we get a deep pullback. And then we got a tail 74, consecutive bear bars, probably going to get a second leg down. And then 75, another bear bar. But what do you notice about 74, 75? 74, 75 overlaps a lot of 74. And that lowers the probability for the bears. For the bears, it's 3 consecutive bear bars, and that's good, but look where you are. You're right in the middle of the most recent bull leg. We had a surprise, 67 to 72. And the midpoint of that rally is right where we are. So this is a possible wedge on a smaller time frame. It's hard to see. but basically, we do like this. So this is 1405, and that's 1445. Go to a 2-minute chart. It's right here. So the market rallied, forming a spike pullback channel with a bear bar and a pause, consecutive bear bars, pause, and then another leg down. So it's a little bit of a parabolic wedge, and the risk reward is bad for the bears. If you're selling down here, stop up here, the probability is not 60% that you're going to make 1 times your risk, just like over here. If you're selling this close, probability is not 60% that would go straight down. It's more like 50-50. I do think the 3 consecutive bear bars is strong enough for a second leg. And then 75, 77, 76, that's a strong enough reversal that we may get a small second leg up and have to go above 72. But 4-bar bear micro channel, I suspect sellers some distance above. So I'm not willing to buy, even though it's late in the day. 77 is actually a bad bar. It's more of a sell the close bar than a buy the close bar. And you can see 78, and then the market went sideways for the next 2 bars. For stop entries, let me just talk about always in. Bulls, they can buy above 6, or they can buy above 8, but if they do, they probably get out below 13. Bears, they sell below 13. And where do they get out? I think most get out above the 17 high here. Bulls, they can buy 17. And if they do, or anywhere in here, if they do, they get out. I would certainly get out below, at the worst case, below 27. But 3 legs up, 1, 2, 3, I would get out as 27 starts to reverse down. A wedge, whenever you get a wedge in a trading range, you expect a couple of legs sideways to down. And I think always in bulls, always in bears, get out above any bull bar in here, or above 36 or 37. Bulls, they can buy, but you're buying the first trend line break of a micro channel lasting a lot of bars. So it's a little bit dangerous. The odds are you're going to get a trading range and have to go sideways, which means we could realistically fall below the 36 low before the bulls get a rally. And then 39, I thought bulls get out above 40 because of the possible failed breakout of the bull channel and the nested wedges. 3 pushes, 1, 2, 3, failed breakout below the wedge, or you can say 32, 36, and 39, and then obviously bar 1, bar 17, 39. Always in long above 40, 41 or 42, you can buy for any reason, especially, but you probably need a wide stop. And bulls, where do they get out? They can get out below 61, but really tough. If I got out below 61, I probably would not buy again above 62. And then bears, if they're short anywhere in here, they get out above 68. Bulls, they buy 68, and then they probably get out below 73, 74, or even 75. And then really too late to do anything in here. Limit orders, lots of limit order trades. Buyers below 4, buyers below 9. I thought sellers above bars, sellers above the bar 10, the bear breakout. I thought sellers above 11. I thought sellers above 15, but it didn't trigger. 3-bar micro channel, strong enough breakout, follow through, second leg down. I thought buyers below 20 and 19, but probably closer to the 16 close. Buyers below 23 for at least a small second leg up, but sellers above 23, bad high 1, and then I thought sellers above 26 for the possible wedge, 18, 22, and then 26. Sellers above, but I'm not going to sell the first reversal up after 36. We're too low in the channel. We're too low in the trading range, and I'd rather look to buy somewhere down here. I thought buyers below 44, buyers below 51 or 52. Climactic bar probably going to go sideways, and then tight trading range, limit orders. Better to look to buy below bars than sell above. And then I thought sellers some distance above 60, bar 70. Typically, when you get an inside bar like 70, especially in trading range, late after a couple of legs up, it's common to get the inside bar to be retested within a bar or two, 71 or 72. So the odds were after 72, it would test back to the 70 high. And then here, a little bit of a bear breakout below a bear channel, hard to see on this time frame, but tail 73, tail 74, and then a bear bar 75, trying to brace the downside and reversed up. Another way to think about it would be similar to this. We have a bear leg in a trading range. We probably see it better in a 1 minute chart. Sell off, another leg, another leg. So it's basically a wedge. 1, 2, 3. Right here. And then the bears, they had a bear breakout below the wedge, but it's basically a second leg trap. We had a bear leg in a trading range, rallied. We tried to get a successful downside breakout, and instead it failed and reversed up. Buy the close, sell the close. I thought probably buy the close on 7 or 8. Higher probability to wait for 8. And you can sell the close at 16, but dangerous low in the range. Probably better to wait and see what the follow through looks like. And I thought sell the close. The first clear sell the close was probably 28 or 29. It was 3 legs up, 18, 22, 27, and we have a 3 consecutive bear bars, 27, 28, 29, and a magnet below the 16 close or the 16 or 17 low. Therefore, there was reasons for the market to sell off here. Sell the close 30, sell the close 31, but getting late in the move and at support, so really not ideal. And then probably buy the close 42, but I think higher probability to wait and see the market stabilize by the moving average 45, 46, 47, 48, all buy the close. You can buy the close at 51, especially if you can use a wide stop. Better to just wait for a pullback. And then I thought 54, probably more buy the close than sell the close. And in 69, I thought was incredible, buy the close bar. Same thing with 70, but a little bit aggressive. And that's probably it for buy the close, sell the close. Let me take a look at questions. All right, question. How do I trade if I see a problem with every bar? Well, that is the 40-60 rule. 90% of the time, the probabilities are between 40 to 60%. 10% of the time, there's a situation where the probability far outweighs the other side. For example, probably 41. There's greater than a 60% chance that you're going to go higher. No, and that's a subjective statement that Al talks about. Because the reality is, is there a 60% chance that you're going to make money is there a 60% chance if you buy the close of bar 7 and you put a stop below 7 and you go for exactly 1 times your risk and you just hold on to the trade and see what happens, is there a 60% chance you're going to make money? Not necessarily. If you buy the close of 7, there's a high probability if you buy the close of 7 and you buy more around the midpoint and you get out at your first entry, you have much more than a 60% chance of making money. You probably got close to an 80% chance of making money, maybe even higher than that. But that goes into management. You're always going to see an issue with every bar. And whenever you don't see an issue with every bar, it is important to understand that you're being blinded. Just think about it. Would you really want a market where, if there was ever a market where one side clearly had high probability and the other side did not have high probability, or let me back up. A market is designed to have incentives for both buyers and sellers. There needs to be a reason for traders to trade. And in order to have a market be successful at facilitate trading and tighten the bid-ask spread to allow traders to trade, in order for that to happen, you have to have a reason to buy and a reason to sell most of the time. Otherwise, traders will stop trading and price will get vacuumed. You'll have price discovery and the market will vacuum to an area where traders will agree on a price level. So the way you get over how to trade if you see a problem with every bar, well, your question immediately tells me that you do not have an understanding of what it is you're trying to trade. And that's just fact. That's just real. So if you're trying to trade, you have to have an expectation behind that trade. And it's different for every trade and every setup. There has to be an expectation. And if you don't have that expectation, then you're going to be misguided. That's why I talk about it. I talked about it in the trading room. You have to understand the difference. You have to understand context. You have to have a way to filter context. And if you don't, then you're going to mess things up. So the way I filter context is the moving average. When you have 10 or more bars, mostly above the moving average, it's a trend. It's a tight bull channel. You can call this a trend. It's trending price action, but it's obviously in an overall trading range. And because of that, I'm more interested in looking to buy than sell, but I'm a little bit skeptical of looking to buy because it's in a trading range. This over here is much different behavior. This is trending behavior. And therefore, I really only want to look to sell. The question, when you do your end-of-day reviews in the future and point out changes in the always in long, always in short, can you elaborate a little more in detail on exactly where and what bar and why the market is entering always in long or always in short at this particular point? Thank you, and I enjoy your reviews. They're very helpful. Yeah, so the point always in is really asking yourself, what's the probability of a second leg? So if you say it's always in short, you think the odds favor a second leg down. If you think it's always in long, you think the odds favor a second leg up. Markets are fractal, and therefore there is a lot of nested patterns inside of other patterns. So what does that mean? That means that when you see a bar, when I say the market's always in long on 7, it's because the odds are we're going to go above 7, even if we pull back first. When I say it's always in short on 13, that's because the odds are the bears are at least going to get an attempt at a second leg. We had to sell off on 13. It's at least going to get an attempt at a second leg. But what you have to understand about always in is you have to understand the difference between a major and a minor reversal. And I talked about that a lot, so go to the recording and re-listen to today. What I talked about was whenever the market is whenever the moving average is flat and the market's in a trading range, you're facing a series of minor reversals. And what that means is minor reversals cause the market to shift back and forth repeatedly. And the reason for that is leg counting. The odds are when you get a second and third leg, there's a much higher risk that the market fails and reverses. When you get a second and third leg up, there's a much higher risk that the market fails and reverses. I'll talk more about that, though, in the future. Okay, question. Brad, is a 1R profit target enough if a trader bought above bar 17? Or does he need a 2R profit? Yeah, so R stands for risk. And I'm going to make the assumption he's talking about initial risk. So if you buy above 17 and you put a stop below 17, is it justified? Is the trade justified in going for 1 times your risk? Well, I have a few thoughts with that. One, it's probably okay, but the way I think about stop entries is whenever I'm buying at the bottom of a trading range, I'm always trying to gauge what's the probability of getting a couple of legs up. What's the probability of getting a bull breakout of the trading range? So when I take a stop entry, I want to give the market a chance to break to the upside. So let me read the rest of your question. So the point is, basically this person's asking, do you need a 1 times risk or 2? And I think most traders are better off always going for twice the risk. And therefore, you buy above 7. That's why I talk about always in. Learn to understand where the always in traders have to exit. So if you buy above 17, stop below 17, where do you have to exit the trade? And you have to exit the trade below a bear bar, closing below its midpoint. And this is below a bear bar, closing below its midpoint, especially in the second or third leg. So 27, that's a large bar. I'm getting out. And other than that, there's little small things. For me, my preference for targets is using price action more than, and I'm measuring initial and actual risk pretty frequently. But if I'm buying above 17, I'm initially taking a chance that the market rallies above 16. So if I buy 17 and I see a bull bar like 18, that's a strong enough bar, we're going to get a second leg up. When I see 19 pulling back, there's probably buyers on the retest of 17. Why? Because there's bears who sold 17, disappointed 18, getting out at their first entry, the 17 high. And that increases the odds that traders who buy 17, they can buy more on 19, and the market's probably going to get a second leg. Now what about 20? Well, 20 is 2 legs up. We rallied on 18, pulled back, rallied again 20, around the midpoint of this bar. There's increased risk that we have to pull back again. And therefore, a lot of traders are not going to buy the close of 20. If anything, they're going to sell it. However, that probability changes on 21. As this bar starts to go down, you have traders buying back their shorts. So the point is, the way I think about swing trading is first understand the overall direction. You buy above 17, you put a stop below 17, and you hold for 2 legs. And you take a chance at getting 2 legs. And then you get out somewhere up here. For me, 1R, if I'm exiting, I think 1R is a bad risk-reward trade. And generally speaking, if I have a 1R trade, that means that, especially in the trading range, that means I have to be fairly quick to manage that trade. And, that's a lot different. I talked about this day over here. JP Morgan, this is an example of a small pullback trend. Traders you can sell the close of this bar, stop above. The bar is big. The odds are you're going to get a measured move down. So you can sell here, stop above, set a target down here. You're going to make 1 times your risk. Nothing wrong with doing that. However, buying the close of this bar here, when the market's been mostly below the moving average, not ideal. Buying this bar right here, stop below, going for 1 times the risk, not ideal because you're in a small pullback trend. Here, buying this bar in the bottom third of the range, you're probably going to get a couple of legs up, so it makes sense. I know that sounds subjective. In general, I would try and go for twice the risk in 2 legs. And if you're long and you see a bar like 27, just get out. When I'm going to get in long on the close of a bull bar, does that mean I click market buy 1 second before we're exactly on the bar close, or when I execute on a chart, would I instantly drag a stop or limit order onto the closing bar? Yeah, it depends on the situation. So basically what they're asking is, if I want to sell the close of 29, when 29 closes, do I hit sell the market with a market order and get short, or do I set a limit order at the close of 29 and get filled? The more trading range price action you have, the more traders adjust the order. So instead of selling the close of 29, they sell the midpoint, the upper third of 29, or they set a limit order to sell the close. But look what happened on 30. Same thing. The difference is I measure it with urgency. So in a situation like this, where I desperately want to be in the market, I don't care about do I buy at the market or buy on a limit. I'm just going to buy at the market and get filled because I want to be in the trade. I'm not worried about missing out. I'm not worried about missing the opportunity to get a small 1 or 2 point, 1 or 2 tick pullback. So the reality is it just depends. It depends on the overall context. And the more trading range price action, the more I like to delay entries. Don't sell the close of 29, look to sell a pullback around the midpoint of 29. But in that case, I sold below 27, stop above 27. I'm not going to just simply exit on 29 just because I think it's going to pull back for a few points. I'm going to stay short, expecting a second leg down. Got a question, Brad? Where would your stop have been if you took the high 1 bar, the high 1 buy on 55? Yeah, so if I bought above 55, where would I put a stop? That's a tricky question. For me, I was long here. I bought below this bar, and then when 55 rallied, I put a stop below 54. But the reason was at a target right up here, and it was going to be fairly quick to get out. And I think it got out 2 or 3 ticks below the close of 51. But in general, if I'm buying above a high 1, I'm probably going to use a tighter stop. If I buy above 55, I'm probably going to put a stop below 55 because the management's the same. We rallied on 55, paused 56, second leg up 57 at the top of the trading range. I really don't want to be long at the top of the trading range. And the other issue is I don't want to be long up here and have a stop somewhere down here because the odds are I'm not going to get that risk. The odds are we're probably not going all the way up here before we have a pullback. And you can see we had almost a 50% pullback from here. Well, you get the point. We had a fairly deep pullback. So for me, I'd rather wait. So I would use a tighter stop in that instance because the odds are I'm not going to, in other words, I'm not going to stay long below 65. And I talked about that. The risk was a downside breakout. Okay, so it looks like that is it for questions. So where do we go on Monday? We have a tight bull channel and a bull bar forcing traders to buy relatively high. The odds are there's probably buyers on the whatever reversal down we get, but strong enough rally, probably a second leg, but a trading range overall, and therefore added risk we get a deep pullback. So I think next week we're probably going to get a pullback, but we may have to go sideways for several days first. So I don't think we're going to go straight up. If we do get up here, I suspect there's sellers probably above. Okay, thanks everybody for watching, and I hope everyone has a great weekend.